Sorry about the delay in the start here. But what we're going to do is we're going to take a look at software that we have at DTI and some of the things that we're looking to do to improve that software, show you a different way to view the market than maybe you have been seeing. Now, most people are familiar with what we're trying to do, which is look at opens, highs, lows, see exactly where the market is going. But I'm going to show you kind of a different view of it. Let's start off with the basics, though. The picture that I've got in front of you, you can see a little bit of it in the background, is my roadmap software from DTI, and we'll talk about that as we go forward a little bit. I'm going to show you a few pieces of it and some of the things that we can do that might be a little bit different than what you're doing in a lot of software out there. But most of charting software is all the same. You know, you got your quotes pages, which is this area right up here. You can see open, high, low, last price, all that information, net change, whatever you want. You got your charts, which everybody should be familiar with. These are simple 30-minute charts. We have a time and sales window down here. You can see when the last time trades were occurred, and that was when I took a screenshot of that. We'll view that live a little bit later. Couple different little toys that we've got within roadmap software that you might not have anywhere else, but just going through the basic things, we want to look at why do we look at particular numbers? Why are we seeing certain things? So let's go to key market opens. And when we're looking at key market opens, there are two considerations in regards to an open. And the first of the considerations is simple. The first consideration is, are we above or below the open? Basically, what direction is the market going? And the dilemma you get in here is when you start saying, well, the open of what? Are you above the open of the day? Are you above the open of the week? Are you above the open of the month, the quarter, the year, the half hour? What are we looking for? Well, we use what we call the horse race. And I'm showing you four major U.S. futures markets, the E-mini S&P, Dow futures, NASDAQ, and the Russell 2000. And one of the things that you're going to look at here, and notice this was taken early on Wednesday morning, and obviously the market's moved up a little bit since then. But notice the color. You guys can see the color that's here. Everybody should be able to see that. Everything's coming up in green. We got a lot of green on the board. Actually, Dan, I've done this before, just the image came up a little bit differently, but hang on. Let's deal with the content. So we've got a lot of green on this board. We see that the E-mini S&P up on the year, month, week, day, same with all of these markets, and we can look at the percentage. How strong are the markets moving? How much further up do we go? Well, you look at all this information, and it's pretty easy to see this is a bullish market. All right, there's really no debate about that. You can debate about, well, is it bullish enough? Is it too bullish? Is the market going to turn around? You can have those questions and those debates all you like, but the simple fact of the matter is you look at the opens of every time period you possibly can, and you come to one conclusion. This market's been moving higher. That's what opens tell us. Now, I'm going to continue on. What it's showing, it's a graphic representation of percent change, percent from open. And it answers whether or not the market is up or down. Open of the year, 37.75. We're above that. Open of the quarter, 18, and actually I got to correct this here. That was the March open, 1864, the open of the quarter. Open of the month, 1921 quarter. And then where did we last trade? Last traded, settlement on Friday was 1953 quarter. So up, up, up in all cases. Now, a couple things you can do within the horse race. You can configure this to where you're looking at specific time frames. And I'm showing you here where we can go down to plugging in a time. This was 1 o'clock, which that's 1 o'clock Central Time. So when you go into Wednesday on FOMC day and you've got a Fed announcement coming out at 1 o'clock, you want to see how the market reacts after the Fed announcement. In this case, it was a positive reaction. Reference, which at DTI we use reference bars. That's how we sort of break the market up into particular days. These are bars that we reference to determine if the market's moving above or below the bar, not just the open, but also the range of the bar. And then you've got your day which, that's from where the market opened. When you're looking at a stock, that's 8:30 a.m. Central Time, 9:30 Eastern. I can go ahead and do, 7:30 Mountain, 6:30 Pacific. Translate that all the way over into London. That would be, I believe, 2:30 in the afternoon in London. So we look at the market from that perspective. Of course, your futures markets will open from the previous day. You open a calendar day in advance. So be aware of what market you're trading, what the hours are, and how that could impact what we're looking at here. But we've got basically just a look at the market here. And when you look at this, again, all those bars are green. There's a bullishness to the market as a whole. All right, now let's move down, and ranges in roadmap, research key, but also on the research key, you can check out where the opening prices are. And this was taken again back on Wednesday. We can look at the 17th, open at 1929. Actually, this was taken on Tuesday, so 1929, 1928 Monday's open, and push the market forward. Look at high, low, where are we moving? Now the research key shows open, high, low, close on a day-by-day, week-by-week, and month-by-month basis. And by flipping through the tabs, we can see what the numbers have been. So we get to see if the market is positive or negative, moving higher or moving lower. We also see, based on the color coding, how the market is moving in relation to the most recent numbers. And if you come over here to the live research key, which is why I have this set up this way, look at the red and green colors, and you can see the way the month of June has advanced. Let me make that a little bit larger, actually, so we see the entire month. Bring that PowerPoint back. But you can see the entire month here, and you know if a market is moving higher or lower. Now, most people would tell you, most traders will tell you, that charts are the way to go. Everybody wants to pay attention to charts because you want to see the direction of the market, and it's simply up or down. Which way are we moving? And most people's minds work graphically. But to be a great trader, to be an intelligent trader, you've got to be able to recall numbers, because sometimes the market will move away from where the chart has been, and if you can fall back on the numbers that are represented by that chart and have an understanding of those numbers in your head, then you have a much better opportunity of identifying what is occurring within the market. So on the research key, we've got these numbers, but just out of curiosity, how many of you look at that and think boring? There's a reason that most traders don't use tables. All right, so how many of you are sitting out there thinking that this is kind of boring stuff? Just kind of want to get, the table over here. There's no way you're going to use that on a daily basis, right? Okay, so I got at least one person paying attention. All right, that's good to know. So, kind of boring view of the market, but it does tell us the numbers we want to know about. It tells us about these opens. It tells us that the market's moving higher. It tells us about the highs. Are we making new highs? Are we making lower highs or higher highs? Same on the lows. We get to see how the closing prices are doing, and you can see the direction of the market based simply on the color coding here. Now, keep that in mind because we're going to come back to it in a second. I want to talk to you about key numbers and ranges. So where opens are showing us whether a market is up or down, ranges represent points at which the market has shown either support and or resistance. Don't we trade according to the current info? We do, Lee, but what do you do when a market has moved, much like this one did last week? We go down from setting a high at 1954.75 all the way down to 1919, and most of the current info is 20, 30 points above you. When you look at it on a chart, and I'll show you this on a chart, it's a good question, but if we go to a daily chart of the E-mini S&P right here, Let me just switch over to new time, daily. This is actually the SEP contract, so there's a little bit of confusion, but look at where you come down and open on the 13th. You're down at, and that's showing 1923.50. I think that hadn't rolled over at that point. So that's showing the 1923.50 area, and well, the market was already moved away from it. Today means nothing for tomorrow. There is some truth to that, but there's also, it's not a complete truth. What's the disclaimer that we all have to go through? Past performance is not necessarily indicative of future results. Absolutely true. You don't want to get caught making the mistakes of the past. You don't want to be an automaton and repeat the past. That's not what the market does. It is ever changing. But there's a reason we put the necessarily. Past performance is not necessarily indicative of future results. And I would say, Hagit, of your statement, today doesn't necessarily mean anything for tomorrow, but it could. And the market has a long memory. And part of that memory is what we have in numbers. The memory of the market is built in the numbers you see here. Yeah, for swing traders this works, but also for intraday traders. You get to begin to see moves, and we're going to get to that in just a little bit. I want to talk to you guys a little bit more about, let's see, ranges and roadmap. I like to use what I call my targets page, which actually, let me slide my PowerPoint over a little bit. And you see the targets page right over here. Let me slide this over. All right, so I've put on this this screen capture on the PowerPoint E-mini S&P weekly, monthly, and quarterly all together, so you can see how these markets were performing. This was back when we were trading at 1949, which is not that far away from where we're trading right now. So what we've got here, we've got the open, high, low, average range, and then we use a statistical calculation based on the ATR of where the market begins to get bullish, where it begins to get bearish for each of these time periods. These are our bull and bear numbers, basically support, resistance. So the resistance number at being the bull, 1939, when the market this week got above 1939, that's when you needed to start being bullish. When it got below 1916, which it never did, that's when you would start looking to be bearish. Now, again, past performance not necessarily indicative of future results, and you have to make trading decisions when it comes to being a trader. This is not a black box thought process. I don't want you to think of it as black box. There are no immediate answers. What we want to do is encourage you to think about the market, to talk about the market with like-minded people, and to have some sort of an education on the market. Just, it's a good idea, even if it's just doing things, going to, I don't know, Wikipedia to look up information. You need to know a little bit about what you're looking at. The targets page allows us to view a market through a comparison of different time frames. It calculates expected levels of support and resistance and visually displays that the market has exceeded expected support or resistance. And you can see on this picture here, the last traded price above the bullish level on the week, the month, and the quarter. Obviously, the quarter we're doing great. We're up here at 1949, and it got bullish at 1906. It got bullish long before that, but it was confirmed to be bullish at 1906. Now, let me slide this back over, and we can look at the performance of major markets. These numbers are going to be hard to read because you're looking at a small projection, but you can certainly see the colors that are out here on the side. And you can see that most of what we're looking at when it comes to our major futures markets, the E-mini S&P, Dow, NASDAQ, DAX, Eurostoxx, and the Russell futures, they're all pushing higher. They're all showing higher price levels. By the way, you can put a stock in here if you like. How do we determine the bull or bear number? It's a statistical calculation based on the ATR. So I'll give you a hint. If the bull number on the E-mini S&P is 1939, right? The open of the week is 1928. You're dealing with roughly 12 points. It's actually about 11 points. We round these numbers out. So call that 11 points. You've got an ATR of 44 points. What percentage of the ATR do you think that represents? That's one of those secret formulas that I've always been amazed that they're secret formulas because I can do math too. So what is 11 points of 44? Anybody figure that out? What percentage would that be? 11 is what percent of 44? Okay, great. So it's good to know I'm speaking to people who can do math. Right, 11 is 25% of 44. So that's what we're looking at there. It's rounded out, so it kind of gets hidden a little bit. So you look at 12 of 44. Well, that doesn't make any sense, but 11 of 44 makes perfect sense. All right, so let me go ahead and continue here because what I want to do is I want to show you not just what the roadmap's capable of, which you can see that in the research key, in the targets page, in the horse race that we looked at earlier. That's pretty simple stuff. I want to show you a new thing that we're looking at, which is going to be coming out in our 2015 version of Roadmap, which will be launched in January. So literally, I'm showing you this before the programmer has gotten his hands on it. So what I'm going to do is I'm going to use Excel spreadsheets to display what we're trying to do here. And hopefully I'm going to show you how much easier it's going to be to have the computer do it for you. But even if I don't do that, I want you thinking about the markets in the way that I'm about to show you. We're looking at what we're calling HLO charts. And that name is that's just the working name right now. So we might have to change that around. We'll have to look around, make sure we don't infringe on anybody. So if I'm infringing on anybody, this is just, for working arguments. But this particular chart is a graphic representation with a number emphasis on past history leading up to current market views. So we're going to take that boring research key, and I grabbed the wrong title bar there. We're going to take that boring research key and bring it alive a little bit. Show you what exactly this particular bit of information is telling you, but do it in more of a graphic representation so people who are more graphically oriented can see it. And the reality is that when you look at people as a whole, the world as a whole, there are typically two types of people. People who are oriented on the detailed information, which would be like your research key here, tables, and many of us who were trading before the year 2000 or so, tables were how we got the information. And it's been a very recent evolution where we're actually looking at live charts. Charts used to be you would get your table and then draw your chart. So the tables, the research key, that's kind of how everything used to come to us. And we've gone, I think, a little bit too far in the other direction where everybody's now graphically oriented. And the reason I say too far, there's not a problem with being graphically oriented, but there's a problem with not knowing what those graphics truly represent, the numbers behind them. So when we're looking at high, low, and open, you might think a certain number will be resistance in the market, but you know the market has not traded below the low. I know that 1919 number, which we saw on Friday of last week and on Monday of this week as a double bottom. You can see it in the chart, but I know it in the numbers as well. So as we were moving forward into this week, the market immediately gave you a sign that it could be going higher. And you can, again, the charts work here, but they don't really tell you what numbers to pay attention to. So let's go through, and this is breaking numbers in the E-mini S&P. This is basically your HLO chart, and I'm showing you first quarter, April, May, June. This is a big view, a monthly view of how these charts would work. So what we're looking at the low of the first quarter, which was 1732, set in February, by the way, the low of April, the low of May, the low of June, and at the end of June, April, May, and June would compound down and be second quarter, and then you start out looking at the month of July. But right now we're still in June, and what we've got the high of the month, the high of the year, the all-time high at 1956.75 for the E-mini S&P, low at 1913.75, opened at 21 quarter, and then you look at the numbers in May and the numbers in April, and of course the numbers in the first quarter. And what we're seeing here, I know if this market comes back down, I know what numbers to start to pay attention to. Now, I want you guys to look at it, and first of all, I want to ask you a very simple question. Based on what you're seeing on this page, on this chart, what direction is the market moving? Up. All right, great. And you could do that without the little lines drawn on the page, because this is effectively giving you that same sort of view, but it's doing it with the numbers focus. So now on the chart, you'd actually have to go in and put your cursor over the bar, and let's do this. Monthly, or I'll do monthly chart here, and I'm gonna cheat a little bit because we just went through rollover. I'm going to use a continuous chart. Not all data feeds have that capability, but we can take a look at it here. All right, so here's what I've got on the chart. Now this is the month of May, right? Taking a quick glance at it, could you see what the low of the month is? What the low of May is? The yellow number was the open. Okay, so you can't see what that low is. You know that if we get down there, it's going to be a big deal, but you can't see it. Whereas if I go back and show you this page, what was the low in May? $18.54.50. Right out there. These yellow numbers are the opens. This one is the current open that we're looking at, the June open at 1921 quarter. So if I asked you, if we get below 1913.75, which is the current low of the month of June, where would you expect the next level of support to be? What is the next number to pay attention to? This is kind of a trick question, because you might be thinking 1854.50, which, yeah, that would be one. All right, but Kurt's coming in and he's saying 1879.50. And you're looking straight back at May, but also don't forget the April high at 1892. 1892.50. Someone actually said that. Vin got that. So 1892.50 is actually the next big number. It's back in the April high, right? And you aren't going to look at a 30-minute chart and think that you have to pay attention to the high of May. That's not in your head. That's not in your mind. But part of trading is about breaking into ranges and trading inside ranges, ranges that have been established before. When we look at the numbers this way on this chart, basically each number has a level, and they're organized, of course, quarter, month. We're looking at that information, but we're also looking at each number on its own individual level. So the difference between 1913.75 and 1892.50 is greater than the difference between 1913.75 and 1921 quarter. But they're the next major levels. Now you can take this out and you can look at it on a weekly, on a daily. We can do all that kind of stuff, but when you go into a daily view of this, there's a lot of information there, and it would get kind of confusing. So we're going to set this particular chart up primarily for swing traders to begin with, looking at the monthly view. intraday traders, we're going to get down into the daily and the nitty-gritty. You'll have that ability within the charts when we launch them in later on. We'll do the beta versions later on this year, and the official launch would be in January. And it's an update to, or an upgrade to, our roadmap software. But the key is that we are looking not at the distance the market needs to travel, but at the number it needs to travel to. Do I consider the close at all? Donna, I really don't. I really don't consider the close, because in my mind, as a trader, I'm always looking at the next opportunity. So the close is simply the delay until you get the next open. Those opens are going to mean a little bit more. And here's the way I'm going to look at it, just to I've got breaking numbers in the Dow, so you can look at the numbers in the Dow, and I'll go ahead and answer this question from Donna, which is, do you consider the close at all, or just the open, high, and low? The last traded price of the market is probably the most important thing you pay attention to. But the close of any particular time period is perhaps the least important information. Because once it's closed, I don't need to pay attention to it. I can't trade a closed market. So the last price is extremely important. A lot of people confuse last price and close. Because of the extreme importance put on last price, everybody puts importance on the close. But let me ask you something, and just a simple question. And I'm trying to think of a way to phrase this where it's going to make sense. The only thing I need to know from the closing price is the market up or down? Well, if I just have the close, I have no ability to see that. But if I compare the last price to the open, or that close to the open, I know if we were up or down. Now, once I know if we were up or down, if we were up in the month of April, and we were, what does that mean going into May? Well, it doesn't mean all that much. You would think it does, but it really doesn't mean all that much, because May is going to open at 165.15, and at that point, the open of May means more than the close of April. So I don't go back and look at historical closes, but I do pay attention to the last price. Because every time period ends and a new time period begins, and it's the new time period that you're trading, not the old one. So it's always the open, and I'll compare the open of April to the open of May, and so I know how the market performed. But we always want to be thinking of being in a live market. What is the next opportunity? So the Dow, let me go ahead and get back to the charts here. The Dow looks very similar to the E-mini S&P. Let me ask the simple question again, what direction is the market moving? It depends on the contract you're trading. In the case of these futures contracts, your daily open is actually at 5 p.m. on the previous day. If you were looking at a stock, that would be at 8:30 a.m. So, or 9:30 a.m. Eastern time. So you do have, of course, you're going to have pre-trading and after trading. One of the reasons I like futures, they're just simply open 24 hours. Pre-market, after-market, now just the market. So I do like trading index futures because of that, because you don't get that confusion of the, what a trade that was actually not a trade because it was before the open or after the open, and it's not calculated, so it's outside of the range. And I don't know why we do that. I mean, if you're going to do that, if I'm looking at a stock using this technology, I would say, when was the first trade? That's your open. When was the last trade? That's the time to move on to the next subject. And the high and low would be calculated by whenever the market was trading. So I think if you're going to trade a stock 24 hours, just go ahead and trade it 24 hours and set your times accordingly. But unfortunately, the SEC doesn't very much listen to me, and apparently neither does the NYSE and all the other acronyms. I don't know if I ran for public office maybe, but I got no intention of putting myself through that scrutiny. So anyway, let me show you a chart that doesn't look like the others, the NASDAQ. NASDAQ, we were very much down in the month of April. And in fact, we broke the low of the first quarter. And this is a market that found a bottom at 3404.75 and then started climbing. Now, one thing that I'm going to tell you here is that the high of the year right now in the NASDAQ is 3806.50. When you guys go and look at your charts, you might see a different number. In fact, most charting programs are going to show you that the high is actually not 3806.50. That was because of rollover. I would expect that sometime within the next week or so, the market may rally up above this level and erase that doubt. So I'm bullish in the market going into next week. Could be a short-term bullish, but for futures traders, just one of those things. There's a discrepancy about what the high is. It is actually 3806.50 in the NASDAQ, but I challenge you to find that on your data feed. Because, and the reason this happens is we have a rollover in futures contracts, which is scheduled for 8:30 a.m. or 9:30 a.m. Eastern time on the Thursday a week before expiration Friday. But we also trade with the mini contracts, which trade 24 hours, which means rollover is in the middle of the day. And most data providers are going to go ahead and flip over to the September contract at the beginning of the day, which would be at 5 p.m. on the previous calendar date. All futures markets are labeled by their closing dates. So when you go 24 hours, you have to do that. So the market that closed on Thursday, the lead contract was September, but the one that opened for that same date on Wednesday night, the lead contract was June, and it changed over halfway through the period. So we're actually looking at the June contract got up to 3806.50 on rollover day prior to the rollover 9:30 a.m. Eastern time. What do empty green bars? Empty green bars, you're talking about this area. This is showing me if that time period was bullish or bearish. So the first quarter was a bullish quarter. We closed the quarter, we moved higher than the open of the quarter during that time period. In April, it was a negative month. May was a positive month, and June so far has been a positive month. So just like with your charts, you get to see green and red and very easily tell if the market was up or down on that particular bar. We're going to do the same thing here on these HLO charts. And let me show you another market that's a little bit complicated. This is the Russell 2000. It uses various different symbols. Since they moved over to the ICE, some data providers use different symbols. So I just go R2K because most people understand R. That might be a little bit tough, but the 2K is 2000, so Russell 2000. All right, so first quarter, April, May, June, and you get to see how the market has moved here. All right, so kind of mix. We've been climbing up, and actually we have broken the 1145.2. Play around with that a little bit. I'll just leave that where it is for now. So the market is moving up. Now, we last traded in the Russell 2000 futures at 1183.2, and looking at this is much more confusing than what we've seen in the Dow and the S&P, but looking at this particular chart, where would you tell me to look for support, and where would you tell me to look for resistance on this particular market, based on the numbers you're seeing on that chart? 66.6 and 91.1. Exactly. And this is the beauty of this chart. And what we're doing, just so you know, we're going back in and we're saying, what is the number in the next row up, and what is the number in the next row down? It happens to be that that's the April high and the open of the quarter. So 66.6 the open of the quarter, 91.1 the April high. Those are the two numbers that we're going to look for the Russell to try and trade around at the next go around. So you should already be seeing the effectiveness of looking at the market this way. And I'm using futures contracts, but you can put a stock in here and look at the exact same information. The numbers are going to be a little bit different, but the way we view it will be the same. So one of the first concepts you need to get through your mind is not, you look at high numbers, and most people think those are only resistance numbers. And you look at opens, and most people think those are only pivots. No, every single number is important, and whether a number is support or resistance depends on the location of the market. So if the market is trading above the May high at 1145.2, which it is, then the 1145.2 high in May is now resistance. At the beginning of the month, it was support, but now it's resistance because the market's above it. Now, we can take this down into a little bit further than monthly information, and this is pretty much the same level, but I've also thrown in last week's numbers, and I've got a blue highlighted area, which this is the active trade area. As long as we stay above the open of May, we're looking at the month of June will have had a higher high, and if it stays above 1854.50, it will have had a higher low, setting an upward trending pattern. What about pivot point? Well, here's the way I look at it. Let's define these three things. First of all, I think you just pay attention to what I call key numbers, just numbers in the market, the numbers that the market has highlighted for you. Now, we put these three phrases on these important numbers: support, pivot, resistance. Now, I want you to think about this. This is going to be a little side discussion, but that's okay. We got time, and I got a slide here that says past performance is not indicative of future results, and there's actually a pitch in here, but I don't feel like pitching, so I'll just put that slide up there, and you guys actually can't even click that. Well, how do we do this? If you're interested, call up DTI on Monday and tell them you want to know about our chat room, which is what this is. And let's see, number is 800-745-7444. But let me get back to that question, and I want to play around a little bit with the software. My boss is going to hate that, but I'm not much of a salesman. I'll let someone else do that. So what about pivot point? Key numbers: support, pivot, resistance. What does support mean to you? Someone tells you to look for support in the market. Where is support? In a directional sense. Any market. You don't have to pull up a number. You're trading at, say, and let's just do the S&P. You're trading at 1953.75. Where is support? The floor, the bottom. It's below where you're currently trading, right? You can't have a support number above the market, can you? So support, I'm going to be looking down here or here or here, you know, these numbers that are below the market. What is resistance? Resistance is a key number that everybody pays attention to that's above where you're trading. And then everybody wants to know, what is pivot? Pivot's generally where you are. Now, you get into all sorts of problems because people have taken the adjectives support, pivot, resistance, and turn them into nouns, especially in the case of pivot. And the noun version of pivot is let's see, what's the big one, the floor pivot, high, low, close divided by 3. There are many people who would tell you that the pivot is the open. You open the year at 1837.75 in the S&P futures. That's a pivotal number. As long as you're above it, the year is positive. Whatever we open at in these futures markets Sunday night at 5 p.m., that's going to be a big deal. I'm not much of a calculation type guy, and which kind of odd to hear me saying that, but I'm really not. In my opinion, and it is my opinion, which I don't know how much that counts for, other than the fact that I'm the one with the microphone. In my opinion, when we look at the market, the least important number of those three, pivot, support, resistance, is the pivot. Because my trading decisions are made on, is the market breaking support, or is that support number going to turn the market around? Are we breaking above resistance, or are we not able to get above that number? It's about, am I passing the resistance and moving up to the next level? Am I passing support and moving down to the next level? You know how many times you pass a pivot number on a daily basis? We go all around a pivot number. I can't really use that for a trading decision other than to say, maybe I should be bullish above the number and maybe I should be bearish below the number. And that's about all it is. That's about all that we get out of pivot. Support and resistance are really where the rubber meets the road. I've got a saying that I heard somewhere before. I can't account to who I heard it from. But the saying is that you make money on the edges and you lose money in the middle. Well, we can break the market down and we can look at it. If you're looking at the highs and lows on the monthly view or on the weekly view for swing trading, you can also go through and look at that same information on throw up a 30-minute chart, and I do a HLO chart for that, but right now my HLO charts are built in Microsoft Excel, and I did take the time to give you a chart of the month of June, and you can see how confusing this could be. But in the context of where we are right now, we're right up in this area. We broke the 52 quarter number, 56.75, now the high. Go back to 50 quarters, probably the next support level. So where are my stops? When I'm looking at the market on this daily basis, you can see that you've got stops that are going to come up into the market. And if we were to break this down and look at it as a 30-minute chart, you can see that too. But just look at the direction of the market, and the black background with the different color on this particular chart. Black background means you broke the high with the green, and black with the red lettering means you broke the low. And you can see the market climbs up and then goes back down and then goes back up. Now, I know that's obvious, but take a look over here. This is what really astounds me. If you're paying attention to highs and lows, early in the month, June 3rd and 4th, you have a double bottom at 1916, right? The market failed to break below 1916 and he started climbing. Big climb up in that first week, getting up to 1949.75. and the next day going up to 1954.75. But the way that you can always tell what a market's going to do, and again, past performance not necessarily indicative of future results, and all the other disclaimers that go along with that, entertainment purposes and whatnot, and make your own decisions and consult your personal financial advisor. And are there any other disclaimers I'm missing? You guys know what they all are, right? You've read them all before. Oh, there is it. Trading involves risk. There's a lot of risk in trading, and you should only trade with risk capital. All right, I think that's got all the headlines covered, right? Okay, so if we take a look at the market, typically one of the things that you see is that markets typically don't give you a turn down on the same day that they set a new high of the year. The economy is better. That is it's a disclaimer. Um, the economy is better, or it might not be, and you should consult your personal financial advisor. Okay, so typically everybody looking at the market is waiting for everything to fall apart. But changes in direction in the market don't typically occur on the same day that you're setting either the high or the low of that particular move. So if we go back to the beginning of last week, June 9th through 13th, right in here, we set a new high on June 9th. But then check out what happened on June 10th. The market did not set a new high. It was the first day since the second day of the month. We did not set a new high. The next day opens at 1950.75, only gets up to 1951, can't get above 51.75. And look at what it did. Sold off all the way down to 1917.50, right? You guys see that? And what happens next? 1750, the low of that move. Next day, we don't make a lower low. Day after, we challenged to see if we could break that. Didn't, and the market went up going into expiration. Now the catch is when we look at these HLO charts and when we use roadmap to show us what this market's doing, you can do a daily chart right here. The market tells us what it's doing. Now hindsight's always 20/20, and past performance is not necessarily indicative of future results. And it's an obvious statement to say this, but it's something people don't think about when they're looking at trading, when they're looking at the market. If the market's not going up, that's usually the time to look for it to go down. If the market is not going down, that's usually the time to look for it to go up. Now, I wonder, has it ever been broken down for you that simple before? And these HLO charts, whether it's the really busy daily chart, which we're going to have to get a handle on that, find a way to keep that a little bit simpler, or the very simple monthly charts, they show us these levels that we're supposed to be paying attention to. So let me open it up to Q&A. I think we got let's say 5 minutes, and then we'll let our next presenter have a little bit of time to get everything set up. But anybody have any questions here? Now, one thing I'll tell you, if you want me to build you an HLO chart on an individual stock, I gotta tell you, building something like this, it's no fun because you gotta go and insert row, and it's no fun. That's why we want the computer to do it for you. But you could probably pull up an Excel spreadsheet and put your information in. And now that you know how to do this, it if you have if you've got something like roadmap software with the research key with the table, or even just going in and grabbing a chart, you can probably figure out how to do that. So I'm not seeing any questions coming through, which means that I may have explained everything a little bit too well. Oh, here we go. Still a little bit confused about the opening time. Is it on the dot 5 p.m.? Yeah, Lynn, when we're looking at futures contracts are nice and simple. It is on the dot at 5 p.m. Futures contracts, when we say these are the hours of the market, those are the hours of the market. You know, everything's nice and simple that way. And it's 5 p.m. Central Time, so that would be 6 p.m. Eastern, which it throws in a little bit more confusion. But you know, I'm a futures trader, and I'm in the Central Time Zone, and I trade markets out of Chicago, and Chicago's in the Central Time Zone. So I tell everybody if they want to trade futures, you know, move to the Central Time Zone, and that way you simplify everything. And DSOP, great question here. When the ATR is minimal and volume tapers, is this an indicator of market trend reversal? Actually, not really. I mean, when you're looking at smaller ATRs tend to be bullish. Bullish markets are grinders. They're boring. They go up a tiny little bit and pull back a tiny little bit and then go up a tiny little bit more. Bullish markets are about the most boring markets you can get into. So you tend to have very small ATRs, and you tend to see a lack of participation. I wouldn't take the lack of participation in, say, the past 2 weeks and say that that's a sign of a possible trend reversal. You know what that's a sign of to me? It's a sign of we had rollover, which most futures traders hate because there's all sort of confusion about what the market really is. Those of you in stocks, you don't understand the way this works. We got a June contract and a September contract. They're both trading at the same time. The high of the year right now at 1956.75 is not the highest traded price of the year. That's what we futures traders have to deal with. So a lot of guys take rollover week heading into expiration off. So you're going to see light volume there anyway. You had the FOMC, so everybody was stopping before the FOMC, and the FOMC scheduled themselves right before expiration. Are you kidding me? Let's look at volume next week and see if it continues to remain low. I think that's going to tell you a little bit more about the market. So sometimes it's the condition that you're looking at there that creates either light volume or less volatility or smaller ranges. Let's see. Learn something new. Oh, great, Pat. I'm glad we were able to do something there. The new Obama law, FACTA. Yeah, you know, I've talked about FACTA before, and how do we calculate the high ATR? High ATR, how do you calculate? I do a 20-day average when I'm looking at the average range. I don't do an ATR specifically. I do a strict average range. Take the range of the past 20 days, add them together, divide by 20. Let's keep the calculation simple. Come on, man. I don't want to have to keep a calculator sitting at my desk. FOMC is using funny numbers anyway. Why does it even matter? It's a good point. But let me go back to say so, and I've only got a few minutes. So first of all, I think there's a lot of misunderstanding about FACTA. It's a silly law, but it's a law that has a lot of international cooperation, and the real criticism of the law is that it requires foreign international banks to forego their policies and actually report on information about Americans who may be trying to hide money for tax purposes, which a lot of foreign international banks have a strict disclosure policy, which makes a lot of sense. So there's a conflict there, except that you consider that there are a lot of I'm trying to remember the name of what it is, like an ISO, or It's an international agreement, essentially, between the sovereign countries that we're going to do this. So it's not just the U.S. In fact, it's a lot of countries involved. What FACTA does, what it effectively does, is it says if you're hiding money from the IRS, we now have the right to find out from the people you're using to hide it that you're hiding it. In other words, when everybody else has to pay taxes, so do you. FACTA makes it illegal to lie about your tax situation. And here's the neat thing about FACTA. Before FACTA, it is illegal to lie about your tax situation. Now, you can park money in an offshore account. That's not a problem. You just have to disclose that you've done that, which you have to do anyway. But what FACTA does is it allows the government to ask the bank that you might be using. So if you're trying to cheat the government, if you're engaged in criminal offenses, if you are engaged in tax evasion, FACTA is not good for you. Oh, yeah, no, they all do it. They all do it. But FACTA basically starts to close some of those loopholes, is what FACTA does. Now, the big problem with FACTA is many countries, many banks do not give up the same disclosure that we expect people to. I think I've run over the time there. And this is a big issue, and a lot of people are going to be talking about it. But the most important thing to understand from the individual standpoint, how it affects you, if you were engaged in tax evasion, you probably need to start disclosing that. Not that you were engaged in it, but just disclose the money, and then, you know, if you make a lot of money, pay taxes on it. What are you worried about? I mean, quite frankly, if I have to pay more taxes, I consider that a good thing. As long as the tax law doesn't change. If I got to pay, what, 40% in taxes, and I'm ended up paying more, that's because I made more. So I'm not worried about it. All right. I think that's it for me.
Okay, well, the topic of the webinar today, this morning, is where are the big fish trades in the market right now? And let me tell you, they are circling, so it's there. They are there. Now, for those of you that have never attended one of my webinars, feel free to go in at any time and submit your questions via the GoToWebinar side menu. Should be right there. Submit the questions. Now, please keep in mind there are a lot of people in the room. I will try to read them as they come in, but sometimes they come in fast and furious, so I may not be able to catch them. And if I miss them, or if for some reason I don't answer them at the time, please feel free to go ahead and resubmit them at a later time. There's no bother at all. I try to answer all the questions as best I can, but I don't necessarily want to interrupt the flow of the information, because it is a little bit of a complicated subject with some intricacies, so we're trying to stay in the flow so it makes the most logical sense. So again, I appreciate that, and again, feel free to go ahead and submit your questions as we go. Here's some little information about me. Again, my name is Dave Aquino. I am a 1995 graduate of Vanderbilt University. I joined Merrill Lynch at the age of 23. My assistant was 33 at the time, and my mentor broker was my father's age. I was the youngest guy in the office, and I didn't know any better. I didn't think that was out of place. So I was with Merrill a number of years, and then my family moved out towards Philadelphia, Pennsylvania, and I joined the Vanguard Group's senior division, and I actually worked in the Asset Management Services Group for 12 years, and me and another gentleman advised multi-million-dollar family clients, and I managed portfolios, individual stock positions with options and other various strategies, and it was a lot of fun working at Vanguard and with my clients. So I had a good handle on basically how wealthy people managed money. And it was very interesting. But now my time with microquant. I have been running the stocks and options live trading room for 11 months now, and I do other things with microquant in addition to doing these informational webinars and running the live trading room. So it's been a lot of fun, a quality group of people, and I really enjoy it. Now some personal stuff. Again, I live outside of Philadelphia, Pennsylvania. We've been living here almost 13 years. A great place to raise a family. I have two 12-year-old twins, a boy and a girl, hitting that 7th grade year, so, middle school. I am a master scuba diver. I very much enjoy scuba diving. I was working on my dive master certification when I was in college also, so a little bit of extracurricular. As my children have gotten older, I definitely have spent a lot of time coaching them in their various sports, and again watching sports. So a little, just so you know who you're listening to today. All right. The risk disclaimer for our webinar here is, again, you've normally seen this before, just for you to know that, again, trading or investing carries a high level of risk and is not suitable for all persons. Make sure that you have the background, the experience, and the ability to tolerate risk for any trades that you take. Now, again, this information is subject to change without any notice, and is provided for the sole purpose of education and assistance in making your own independent investment decisions. Now, we cannot guarantee the accuracy of all the information contained herein. However, we have done our best to make sure that this information is as accurate as possible. Now, again, most importantly, any past performance results are shown for illustration and example only. They are hypothetical and as such have many inherent limitations. Now, no representation is being made that any account will or is likely to achieve profits or losses similar to those shown. And past performance is not necessarily indicative of future results. This is the government required CFTC Rule 4.41. Want you to know that trading in futures and options trading has large potential rewards, but also carries large potential risks. You must be aware of the risks and be willing to accept them in order to invest in the futures and options market. Do not trade with money that you cannot afford to lose. Now, this is neither a solicitation nor an offer to buy or sell securities, futures, stocks, or options on the same. And no representation is being made that any account will or is likely to achieve profits or losses similar to those shown on this website. Again, past performance of any trading system or methodology is not necessarily indicative of future results. If you have any questions on these two disclaimers, feel free to go ahead and contact us at microquant. All right. This is the whole premise of the webinar today. It is basically that if you give a man a fish, you can feed him for a day. Teaching a man how to fish, you can feed him for a lifetime. And this ancient skill of fishing is a fitting analogy for what we do every day trading in the markets. It gives us the opportunity to provide the means to support ourselves and provide for our families. Now, in most places of the world, if you can harvest from the sea, you can survive and possibly become prosperous. Now, keep in mind, there are some fish that are bigger than others. So it depends, your success as a trader depends on how consistently you can bring in fish, and every once in a while that you can catch a big one. Okay, I'm here to show you these big fish trades. And those are those opportunities in the market that are standout chances to make money. So basically, here's the outline for today's webinar. What do I mean by big fish? How do we build wealth with large, profitable trades? How do you catch the big move right from the start? How do I manage my position with little or no risk? What do I do when I have big profits on the line? When do I take my profits? Then I'll show you an example that an example of a trade I recently had in Priceline. That particular trade netted $63,000, and that's a trade I actually had also in the live trading room and managed it. And then I'll talk about what do I see, what's in the water now, what is shaping up in the markets that you can take away and take advantage of. All right, just double check here, make sure I don't have any more questions. Excellent. Okay, what do I mean by big fish? A big fish trade is a winning trade of sufficient profits that it can make a sizable impact in your trading account. Now, I know some people, they trade, they might have a smaller size trading account, and any trade that they usually take is pretty substantial. But when you have a appropriately sized trading account and taking appropriately sized trades, we're talking about a big fish trade that can change the nature of the trading account to the point that it can actually substantially add to the performance of it long term. When I say a big fish trade, we're talking about a 100% plus return or more. We are looking for a quick return on profits, and we're talking about a swing trading type of time frame that usually lasts 2 to 4 days. What we want to do in order to take advantage of the trade, it's also important to control risk, and these trades are structured to have relatively little risk to our trading capital. Zero risk is optimal. Now, a big fish trade, you get a double, a 100% return or more. We're talking about an impact to your trading account of anywhere from 2 to 5%. And some people will tell me, say, well, Dave, every trade I take is 10-15% of my trading account. That's a little bit too big. What I'm talking about is trades that normally consist of anywhere from 3 to 4% of a trading account. A double in there will increase the account by anywhere from 2 to 5%. Sure thing, Arthur. Try to do this. Okay, sorry. I'd moved away from the microphone a little bit. Thank you for asking. Okay, hopefully that's better. Okay, thank you. Okay, so the first step, building wealth with large, profitable trades. Okay, again, long-term success in trading is built upon a steady increase in your account. I mean steady growth. We're talking about daily and weekly consistent profits with relatively small losses. As a professional trader, you realize losses are basically the cost of doing business. But the hallmark of good trading is minimizing those losses so that they don't eat into those consistent profits that outweigh the overall losses that may come about just because of trading. Okay, the next thing is that our trading is punctuated by a healthy dose of what I consider big fish winners. Okay, it's steady, then you have a big winner. Steady growth, and then a big winner. So those relatively bigger jumps in trading size serve to increase the compounding nature of the growth of your trading account. And again, most people focus on, did I get a big score? Did I get it? Did I double or triple my trade? Long-term traders realize that the goal is compounding your account. And then after that fact, you also need to know when enough is enough. If you get to your account to be a certain size, then you don't necessarily have to risk as much per trade. Know when your trading account size is enough to generate enough money for you on a steady basis. Okay. Now, this is just an example of the power of compounding. This should be your overall goal. This is a chart that I use in the live trading room all the time because we have a series of trades that we do, and one of them does focus on weekly returns. And you can see that weekly returns, when applied over time, make a tremendous amount of difference. We usually use this 3% level. If you can consistently compound at 3% per week, that's reflected in a roughly 12% monthly return. So if you start out with $10,000, a reasonable return over a year is around $46,000. Then you can bring that out 2 years, $200,000. Now, I'm not going to keep going and go 3, 4, 5 years here because those are kind of pie in the sky type of returns, but it is a realistic expectation. If you can perform at a high consistent level, you can do something that starts out with 10,000 and realistically could earn 20 times the money just over time. Okay, so again, the goal of increasing a goal of trading should be to compound your trading account at a reasonable, consistent level while keeping your losses small. All right, so let's go ahead and get started. Let's start talking about big fish trading and get into the mechanics of it. The rest of this webinar is really going to be straightforward, talking about trades. We've gone through some of the introductory material just so you know where our focus lies. So we'll just go ahead and get started right now. Okay, catching the big move right from the start. What do I mean by that? What are the big moves? Well, big moves are those opportunities that we can take advantage of in individual stocks and ETFs. Now, big moves are conducted in securities that I consider big fish. Now, big fish stocks and big fish stocks and ETFs are basically large value stocks with large average true ranges. Okay, these stocks make strong directional moves, and these stocks also have highly liquid options. Now, this is optional. It's something that you don't have to do if you don't like trading options. But let me tell you, I'm an options trader, and the ability to trade options in this strategy greatly increases the leverage and consistency of being able to get in with minimal risk. Okay, so again, stocks with highly liquid options. And the examples of these big fish type stocks are Priceline, Google, Apple, Netflix. I just pulled those 4 out, but they're very good examples, and there are more, but those are the ones we like, that I like right now. Okay, let me show you in the form of a diagram here. The big fish, again, Priceline. Its stock price is $1,360. Its 30-day average true range. Its average true range is basically reflecting how much the stock can move in one day. This is a 30-day average. Priceline has been moving average between the high of the day and the low of the day, roughly $30. Google, its price is over $1,200. Its average true range, over $20 per day from high to low. Apple, $530 its current price. It can move plus or minus, well, I'm not plus or minus, but from high to low, about $11 per day. Netflix is another one. A high-low, roughly almost $12 per day. Okay, so that is what I mean by big fish. Now, how do I find these big moves? How do I see whether or not they are setting up? Okay, the power of what I use, basically what I call the power of multiple time frames. Okay, I want to use multiple time frames to identify these trading opportunities. I identify them. Okay, here we go. The longer term time frame, and I'm talking daily and weekly charts. I use the daily and weekly longer term time frames to identify potential turns or breakouts in the market. This is basically where these big moves live, okay? In the longer term time frames, daily and weekly. Now, I'm not going to sit here and be hyper specific today regarding what do I mean by a turn, what do I mean a breakout. I mean, all markets are what we call fractal, okay? That you have a breakout, or you can have a move and then it will turn and have a pullback. That's what I mean by turns. Again, you can have those on 5-minute charts, daily charts, weekly charts. It doesn't matter. The moves are very similar. But when I'm trying to identify big moves, I'm talking about these longer term time frames. Okay? And then I use, once I identify those turns and breakouts on the longer term time frame, I switch gears and I start looking at short term time frames. Okay? I'm talking about 15 minutes, 10 minutes, 5 minutes, and shorter term tick charts. Okay? The purpose of me looking at shorter term time frames is I want to identify an entry. Okay? Those of you that have been trading a while, and those of you that are starting to or already get trading, the most important part of the trade is the entry. If you get a good entry, you limit your risk and you maximize your gains. So that's why we shift gears into the shorter term time frame and start to look for entry trades. Okay? No, Sandy, that's fine. You don't want, you want your entry. The question is there a number that is too small or too big for an entry method? Not necessarily, Sandy. Okay? When you're trying to enter, if you use an extremely short-term time frame, like your 133 tick, you could easily get shaken out of it. Okay? That's the only one thing to be a little aware of. If you're using too big of a short-term entry time frame, you may not see as many trades that will help you get in there. Okay? The shorter the time frame, the more trades you're going to see. Okay? The longer the term, relatively like a 15-minute time frame, you may not see a good entry trade. Okay? So maybe you want to split the difference and look at maybe a 5 or 3-minute time frame. Well, John, I'll talk about that also, but you don't have to follow all of them at the same time. In these big move trades, you just try to identify where the move is that you're hunting. What are you fishing for? Most of the time when I do it, I'll tell you my parameters. Longer term time frame, I use a daily with an eye to what's happening in the weekly, okay? But the setup is in the daily for me, okay? The short term time frame, I will look at a 5-minute, and then I could do 5, 3, or 1-minute time frames, and then every once in a while I'll also use the short-term tick chart. I really don't use the 15-minute as much. Okay? All right, but I will go into it a little bit more. That was a good question. Thank you. All right, so now we know what we're fishing for. We see a setup on the daily chart. How do I get this big fish on the hook? Okay? Again, power of the entry trade. That is key here. We want to use the short-term time frame to carry out entry trades in the same direction as the longer time frame opportunity. If you are playing a breakout, you want to play it in that direction. If you're looking for a pullback, possibly turn in the longer term time frame, then you want to do the opposite, go in the opposite direction. What you are doing, again, and this is most important, you are using the short-term time frame to do entry trades in the direction of where you see the longer time frame opportunity is. Okay? Entry trades for bullish opportunities on long-term time frames. Okay? If you are bullish, and you think the market's going to move higher, what you are looking for are entry trades that are bullish divergences or potentially falling or descending wedges. If you remember those terms, a falling wedge is actually looking for a breakout once it breaks the wedge. If your entry trade is for a bearish opportunity on the long-term time frame, you want to look for bearish divergences. Okay? You want to look for ascending or rising wedges that once they break the wedge, they'll fall. Okay? Bruce, you're saying it looks like you'll be spending an all day staring at your screen. Not necessarily, but it is not necessarily. It all depends on the time frame. I can trade divergences or wedges and stuff like that all day long on a 250 tick time frame, but again, I'll be going into this some more later on. But there are more realistic time frames to look at and times during the day to look for these opportunities. So it is a little bit time involved when you are getting into the trade. Again, you're focusing your time and effort into the most important part of the trade, the entry. Okay? So once you get into your position, how do I manage my position with little risk? Okay? So you're looking for these entry trades. Again, we're using short-term time frames to carry out our entry trades. Again, in the same direction as the longer-term time frame opportunity. Now, once I get my position in place, I'm maintaining it with a small or no risk stop loss. Okay? Basically, that means is, let's just say I am bullish and I get into a bullish divergence. I'm profitable. I have a small profit in my bullish divergence. When I get to a point where I can take some profits off, instead, I just move to a very small or no risk stop loss. I'll move to break even and I'll keep my position on. Okay? What happens if it turns against me and I get stopped out? That's part of it. That's part of it. Okay? What you are trying to do, again, is get into position. Remember, the purpose of this entry trade is to get my foot in the door. It's not to take immediate profits. Okay? So, again, purpose of the entry trades is to get my foot in the door and not make immediate profits. Now, you've got to be patient. You may get stopped out several times, okay? But your job is to be in position for the larger move. Now, sometimes it's a little frustrating, okay? But think about it. If I get into a position, I have a small profit, I move to break even, and I get stopped out at break even. I didn't make any money. I didn't lose any money. I'm still watching the position. If I look on my larger term time frame and it still looks like a trade that is shaping up, I want to step back in, try to get back in, get into a position, okay? That's what will pay off in the longer term. It is a little bit of work, but again, you can't get something for nothing. So you got to be patient, okay? Now, let's say you get into a position, it's in line with that longer term opportunity on the longer term time frame. What do you do? What do you do? Okay? Now, I go back to if anybody's ever been big fish fishing, like sport fishing, this is all the same mentality. Once you get the big fish on the line, what do? You want to maintain your position with a small or no risk stop loss. Okay? Now, hopefully by this time, once your stock has moved in the direction in which you think that you were expecting it to move, now you have a profit. Now you might actually have a pretty darn good profit. What do? That's what I call the profit cushion. Okay? You still want to maintain your position, but you can use a trailing stop. You can do it by the dollar amount. You can do it by if it's moving in your direction, but every once in a while it has a little tiny pullback, moves against you, and then that's a good place to put a trailing stop. But you want to give it enough space to continue to run. Okay, you just continue to let it run. Yes, Alicia, I definitely will. I will show you guys examples. I know you want to visualize it. I will show you, but I need to get out the information first. So you have the mental framework of like, why is he doing that? Why did he put that there? So let me just keep going, and I will go into it. I will show you example. Okay. So again, once we have that profit cushion in place, we want to give it enough space so we don't lose the fish and let it run. Okay? Again, how do I land this big fish? How do I basically you're letting the opportunity develop. You're letting the big fish run here. Okay? We go back, once we get into a position, we zoom out, and now we look at the longer term time frame, because we want to use the longer term time frame as a guide as to when to begin to take profits. You want to construct your exit plan based on the potential move in the longer term time frames. Do you have value targets? If you have value charts or value bars, then value targets become a potential place to take profits. We might use the 8, the 21, and the 50-day moving averages. Those are also good locations to take some profits, because now you have the fish running in the direction you think it's going to run. There's a chance it's going to stop. It just won't keep going and building profits exponentially. It's going to stop someplace. So start looking at those. Okay. Also, you could look at Fibonacci retracement levels, and then you could look at our basic support and resistance levels as good targets to take profits also. Okay, it's great to be in a trade and have profits on your side. It gets to the point where it's a relief that now you have profits, and then as the profits get bigger and bigger, it becomes more and more stressful, because now you don't want to lose those profits. Okay, so again, that's why we zoom out, take a look at a longer term time frame, and then identify those potential value targets. Now, with that said, it's okay to have planned and staged partial profit targets. If you have 100 shares and you can identify 3 potential profit targets, maybe 1 at value, okay, that could be number 1, and then maybe it'll hit the 8 or the 21 EMA, and that's 2, and then wow, you have this big support level down here at the bottom. That will be 3. So you take, if you have 100 shares, well, you take 33 off, and 34 off right there. Okay, great. You reach this level here, then you can just, that's wonderful. Okay, if not, then if it comes back a little bit, then you take the rest of your profits as they come and bounce back. It's okay. You have money now, so it's not a problem. Don't get greedy. There are more fish in the sea, but this is a way to structure how do you take profits in your big fish trade. Okay. What determines a value target? You could use the yellow, either overvalued or undervalued levels in value charts. Bob, I'm going to answer those questions also. What is another trailing method I could use? Well, it also depends on how the stock is moving. If it goes down, let's say I'm bearish, the stock is going down, and it bounces up, and it comes down, and it bounces up, and it comes down. Okay, every time it bounces up and then it starts to head back down, then you could move your stop just above this level. Comes down to here, then you can move your stop to this level. You're trailing your stop, okay, because these are reasonable locations. If this thing starts to turn around and then really starts to retrace, then that stop loss level is significant enough that it represents a change in the the longer term trend that you're trading on. So it's okay to get stopped out there. Okay, it can be any sort of chart, Wayne. Yes, this webinar is being recorded. All right, so let me show you an example, real life, of this big fish trade I did in Priceline back in February. Okay, all right, so this is Priceline, and is one of my favorite big fish trade candidate stocks. You can see that Priceline was making a nice move higher. This right here, folks, was the extent of the big fish trade that I took. Okay, and you can see this is not even a major move in Priceline. This is a move higher. This is a pullback, and it basically is a continuation move. Okay, oops, sorry. It's still moving higher. That average true range frenzy, the 30-day average true range, that's just for an example only. If it's a large average true range on a 14-day, it's a large average true range on a 21, it's large on a 30. I usually use an 8, a 21, and a 50. All right, so again, back to the Priceline trade. You can see the Priceline trade that I'm going to talk about is just this 2-day period right here. Okay, but it's only a pullback in a larger term move. And again, this is February 18th right here. And this is February 20th down here. Okay. All right, so basically I was watching Priceline, and it's one of our trading stocks that we have in the live trading room, so we watch it every day. But you cannot deny the strength of this daily up move right here. Okay, it formed a 3-day base back here early February, and then it moved up strongly for 8 days straight. 1, 2, 3, 4, 5, 6, 7, 8. Okay, even pushed to this MQ trend level resistance here. Momentum was very strong to the upside. It kept pushing higher. Now you can see, if you're familiar with value, the different value levels and value charts, these areas significantly overvalued. Now we know that usually a stock does not persist in the significantly overvalued level very often. Okay, it can't live up there forever. It's starting to signal either a potential pullback in the stock, or how it's getting further and further away from the norm. And that's also evident. You see the distance the current price is from the 8 EMA. We're getting really pulled away from it. Okay, so after hitting these significantly overvalued levels and basically counting the days, I'm starting to look for intraday trades, bearish, kind of counter this move for a potential pullback. Okay, so I'm watching it, and it doesn't mean that I'm automatically going to find the position. I'm not, the purpose of getting into this trade is not to identify the top. Okay, I was looking here and I was looking here. Okay, so this are the 2 days I was watching. So on the day of the 18th, February 18th, now this, keep in mind, this is a 1-minute chart. Okay, this is roughly 12:30 in the afternoon. Okay, so prices came up. This is the high of the day. I like to watch stocks after what I believe is a move into the high of the day. Usually it's in the first opening hour. Sometimes it extends into the early part of the lunch period. Okay, hits the high, and then I'm watching momentum. Momentum falls off back to this 8 and the 21 period, and it comes up, and it's making this price pattern. And what I noticed was there's this descending trend line right here. Okay, so what I start to do is play some resistance trades against this, because I want to be short. I'm buying puts here, I'm selling puts here. I'm buying puts here, I'm selling puts here. Okay, But I noticed that there is this support level right here, and the trend line is coming down. Now, usually on a descending wedge like this, we break to the upside. Here, we didn't break to the upside. We tried to once, twice, and then right here is when, I believe it was this bar, I thought it was going to break through. I purchased some price line puts, okay, because momentum was increasing to the downside. And these two trades here, what did I do here? That's a good question. Okay, what happened here? I actually bought puts, sold puts, and then I kept my I traded roughly 10 calls, 10 puts, sold 5 puts. Bought some more puts here, sold 5 more puts here. Okay, when it broke here, I had 10, I had 5, and when it broke here, I bought 10 more. So when this thing finally broke right here, I had 20 calls. 20 puts. Okay, 20 puts in Priceline. Okay, so once we broke and Priceline moves in a great average true range, we went from 310 to roughly 305. I moved to break even at this point because I had some small profits from here, and then when we finally broke, I moved my position to break even. Okay, basically what break even. Okay, yes, they are weekly puts. Yep. Yes, I am, because I want to establish a position. That's all I want to do. Okay, so now I have puts. I have puts in place, and this is a 1-minute chart. I am at break even, and I'm trading a potential fall from here. Okay, so this is the results. Once I'm in, I'm monitoring the position, but I'm not trying to do too much because I have break even. If it turns around and really shoots up, that's fine. I get stopped out. I have a tiny little amount of profit here. Again, the goal is not to make money right here. The goal is to establish a position before it moves, if it moves. So again, here are those 3 trades. There's the descending wedge. It breaks lower, and it runs, and it runs, and it runs, and it runs, and it comes down. It makes this low of the day, and it makes this low of the day right at the end of the day. That was a bullish divergence, so I actually sold 10 of the contracts, took profits on 10. Okay, so right there, took profits. The next day, we open up strongly when I believe what I saw here was a bearish divergence, or basically a start of a move down. So I actually bought 10 calls back here, the arrow, and then I just let it run. So I have profits from here, okay? I have profits from this move. We bounce back up. I buy 10 more. I actually have more of a cushion because I count the profits here to put a break-even stop way up here, because Priceline does move. But once I get that position, it just runs lower. Runs, 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 runs. So it gets to this point here, I actually take 10 off. I take 10 contracts off. We gap up in the morning. I'm not worried because I have all these profits, plus I have all these profits booked from this move to this move. And then now it jumps up. What's it do? It fails again, and it falls lower. Now this is where I finally sell out of the position. Why did I sell out of that position? And I sold 15 of the 20 contracts. Why did I sell there? Because on the daily chart, we hit the 8 EMA. We hit the 8 EMA, and we bounce. Okay? Basically, this move right here, this was a bearish divergence right here. Okay, it bounced, and then I almost kicked myself because, oh, it's going lower. No, it bounces and it goes higher for the rest of the day. But this is where I sold, right here. So from up here, right around 315, all the way down here to 1260, that is a $55 move. Okay? $55 move. So based on how I took profits and everything, and the type of options that I bought, because they were expensive. Actually, the reason why, I'll tell you the main reason why I got out here is the fact that we had earnings the next day. Okay, someone asked me about this. Their earnings the next day. So I wasn't going to hold it into the close. I really thought we were going to continue to fall, so I was a little bit agitated that I had to sell. And then this is a $55 move. Someone's asking me what was my average cost. My average cost, I don't have the figures right with me, but the thing about it is these options were expanded because of the earnings that week. Okay, if you guys trade options, you know what I mean. So I had to buy very expensive options in order to make this trade. Okay, even though it's $55, if this was a normal week without earnings, the profitability would have been much more in a percentage term. Okay, but they were expensive because of earnings. Hold on. So again, the trade basically was this, from this high right around here and significantly overvalued down to this low on the 8 EMA. And again, see what happens right here with earnings? It pops up higher. So that's why I got out. Okay. Yes, Scott, I was watching the 8 EMA. Because I was watching Priceline because I'm looking for a location to get out. Because earnings are the next day. Earnings were actually that night, so I didn't want to hold. So I am out of Priceline. And honestly, you see this kind of, I did not really know what the total was for the net profit when I sold here. Okay, again, because we made some small profits here, right here. We made some profits here when I sold some, made some profits here, and I made some profits here. Okay, so there's like 3, 4, 5 different places where I took profits. So when I totaled it all up, I was actually very surprised. It was like $63,000. But again, that is the ability to make money in these big fish trades that really, and that was just a pullback to the ADMA. That's not a major move in this stock. Okay, so that's an example of what can be accomplished in a big fish trade. Now, a lot of people are asking me some option specific questions, and I'm more than happy to answer them. Again, these options were relatively expensive. They were very expensive because of the implied volatility expansion because of earnings, but the essence of it still holds. It's a trade in a big fish stock that makes a major pullback move, and because of the size of the stock, it can make a lot of money. Okay, big amount of money. Some of those, again, I don't want to get into the nitty-gritty of the specific options and which delta did I buy, all those kind of things. Honestly, if you take this trade, it doesn't matter if you bought delta 50, 60 or 70, you made money. Okay, but I'd be more than happy to get into those trades, those specifics later on. Okay. Yes, this is an MQ trend index, MQ trend indicator we use in the live trading room. Again, so again, the gist of this trade is the fact that a big fish trade can yield a lot of money in a very short amount of time. Again, over 63,000 in 2 days. Okay, on a pullback. That's not even a big move for this stock. Okay, so I've showed you, I've explained the essence of the big fish trade, what we look for, how we get in, how we manage it, how you can take profits. I've shown you an actual trade that I took, and then next is let's look forward here for you. Okay, what is out there now? What's in the water now that we can take advantage of? And let me just show you a couple of things. Okay, those of you that have been watching the markets What I see in the NASDAQ 100, I see a potential bearish divergence, okay? So we've been escalating right here over the past month. We've come up, we made this high, okay? Corresponds to these green histogram bars right here. We have a pullback to the 21-day moving average, and then we come up here, we make new highs. If we compare the momentum profile here versus here, this looks like to me that the NASDAQ is setting up for a fall. Now, again, you're trying to catch it on a turn, so there's a lot of upside momentum still churning up here. But I'm looking at this potentially going lower, okay? I don't know if it's going to be this week. I don't know if it's going to be next week. But as long as I'm monitoring and watching what momentum does, as well as this particular bar, that's a really nasty looking hanging man bar. See how far down we came down? We stopped on the 8 EMA. This would be much worse if we actually closed below the 8 EMA, but that's not what it did. But I'm still looking bearish. So in the overall market, specifically the NASDAQ, I'm looking for this market to be bearish. So that's the mindset I'm going in when I'm looking for my big fish. Okay, let's look at Priceline. Priceline is one. Again, we had that really good trade. What do I see here? This first high. Look at this histogram profile on momentum. Okay, we come back down, touch the 8 EMA here. I didn't actually trade this one. We bounce up. We make an equally high here. Look at momentum, and is actually red as of yesterday. Okay, hit a moderately overvalued level, and we're starting to go lower. We have a lower low. We closed in a bearish bar. Momentum is red, so Priceline looks like we're going lower. Those of you in the live trading room actually know I have Priceline puts in place right now. I made some money on a little bit of a pullback from this high right there, and then before it closed, I don't like to have positions in over the weekend, but for Priceline, because I had this profit cushion, I went ahead and made sure I have puts going into Monday. Okay, because I believe Priceline can come down too, just like the NASDAQ. Again, I don't necessarily like trading. I don't like trading in the direction opposite that I see the market. I love trading in the direction I see the bigger term time frame. Okay, so I'm looking for a fall in Priceline. Okay. Yes, James. Google, right here, same thing. There's the most recent high. Look at those histogram profiles. Look at this one. We come up here, we hit moderately overvalued this day and this day. Those of you in the live trading room know we call this a no return. No return divergence. Okay? That's a divergence on the daily chart. So what you could be looking at is Google, opportunities in Google to go short. Okay? Because Google is setting up the fall also. Okay. The questions again coming in about options. I kind of don't have the time to go into all those specifics today because options are a creature all into its own, my favorite subject. But again, what I'm trying to do is explain the opportunity as best I can with the general idea. Okay. You'll see later on, I will have the opportunity to talk about how to utilize options there. Okay, so this is definitely starting to fall here. Okay? All right, so question is what are you guys waiting for? I've shown you the opportunity. I've shown you the way we can trade this, a type of trade setup. I've told you what kind of time frames to look at. I've shown you on a shorter term time frame some of the entry methods that we've used, and then now with the example of Priceline, and now looking at these two various stocks, Priceline and Google going forward. Now you should have the fundamentals of what you need in order to go forward and implement some of this stuff. You have the idea. Um,
Okay, hi everybody. Thanks for being here on a Saturday. I know you've got a lot of other things you can do, especially with the World Cup on. And since I don't know anything about soccer, I'd have to go back down to baseball, but a lot of good baseball games on today too. What we're going to talk about is keeping some of that money you were just taught how to make. And I would really recommend you sign up for that July workshop. It's unbelievable how much good education does for each of us. It's absolutely amazing. So today we're going to talk about creating your own tax efficient trading plan. And again, I'm Jim Crimmins. I'm president of Traders Accounting in Peoria, Arizona. On the screen now are our contacts, and go ahead and write them down. That's my personal email account, our website, and our phone number. I will not take questions today during my presentation. Please put them down as they come to you. I know you will have a lot of them. It's not my first rodeo with this particular program, so I recognize that a lot of you will have a lot of big questions before we get to the end. So go ahead and write them down at the end. I will take the time to answer them all. Now, if you've got a question that is personal to you and you really don't want to discuss it in front of this August body, you can email me, and that is jimc@tradersaccounting.com. Okay. So, okay, Jim, you say you're going to talk about tax efficiency. Why do we even care? Well, in my opinion, the most important task an active trader has is managing their cash flow. There's several ways to go about that. The presentation you just heard on options and becoming a better trader is certainly one way to affect your cash flow. But one of the biggest ways is to understand tax efficiency in trading. During today's presentation, I'm going to give you the roadmap. You might not completely understand it all yet, and my big concern is that you think you will, and you'll rush out from this and go do something that may or may not help you. But anyway, what we're going to talk about is the fact that you have the ability to increase your cash flow as an active trader by just doing a couple of things. I know as a trader myself, all of us always wish we had more money in our trading account. The problem is we run into about 24% of our traders each year that bag it. Now, we're not quite sure that we have the reason that they all bag it. Some of them have been out of work, they find a job, and now they can't trade. Some of them have decided, hey, I tried trading, I don't like it. I'm going to go become a real estate investor. And some of them just lose all of the inventory that they had. And the inventory for a trader, obviously, is the dollars you have in your trading account. Also, I know I just finished reading the Wall Street Journal this morning, and a lot of us are wondering why we're paying so darn much in taxes. I'm getting ready to take my motorhome out on the road tomorrow for a vacation, and it just seems always to me that the minute I plan a vacation in the motorhome, which gets a lofty 6 miles per gallon, the price of fuel starts heading up. And a lot of that is taxes also. They can't even fix our roads with the taxes they're getting now. They're trying to come up with some other solution into fixing the infrastructure of our transportation area. But my question to you is, do you really understand the IRS rules about the taxation of traders? Because they are completely different. I mean, they're hugely different, folks. We're going to go into a few of them today, and we'll see, by the time you're through today, you're going to know more about traders taxation than about 90% of the accountants in this country. Now, I'm not knocking accountants because I are one, but what I am saying is that most accountants in this country don't have any clients, or they may have one or two clients that are traders, so they don't have an economic reason for learning the intricacies of trading and taxation. So it's important that you have a little bit so you can manage your accountant, because that is your responsibility. As we start, I'm going to make several assumptions. The first one is the biggest and probably the hardest task you have as a trader is to manage your cash flow, and that includes trading as well as taxation. But here is the key. For every dollar in trading expense that you're able to write off as a deduction to your taxes, you're going to save some percentage of that as cash flow. Let me give you an example. Let's say you're in the 25% tax bracket. Traders Accounting is a tax, bookkeeping, and tax strategization company. And so we have statistics that show that most of our active traders have somewhere between, about $14,000 and $22,000 in expenses each year. I know it sounds like a lot, but we'll go through some expenses in a minute, and so you can see how these things add up. Well, let's just say that our trader Joe here has $20,000 expenses, and he's in the 25% tax bracket. If he's able to deduct those expenses, can you see quickly that he or she, could be Trader Josephine, he or she is going to have $5,000 more to trade with? Now, they didn't even need to make a good trade to get that extra $5,000. They just needed to know what they were doing. However, the IRS treats traders pretty badly, in my opinion, because the tax rules surrounding traders are significantly different. And I shouldn't say tax rules, because most of them are not rules. They are just things that the IRS has thought up to make crossing the road a whole lot harder. They took the stop light down and they took the crosswalk down. So now you've got to dodge those big 18-wheelers going across the road. They consider most trading activity to be a hobby expense, which is non-deductible. Now, in order to not be considered to be a hobbyist, you have to trade as a business, because hobby expenses are non-deductible. Now, I'm also going to tell you that your largest expense as a trader, unless you just go from one trading school to another, your largest expense is going to be taxes. There's just no doubt about that. Going on with the assumptions, there's two tax codes in this country, one for individuals, one for businesses. Now, individuals, as an individual or as a hobbyist, we're able to deduct very, very little. We can deduct our kids, we can deduct some charitable contributions, and a few other things such as that. Some medical, if we can ever get above the 7.5% threshold to be able to do that. Businesses, on the other hand, according to the IRS Section 162, are able to deduct all ordinary and necessary expenses for the business that they're in. Now, it's up to you whether you want to be taxed as an individual or as a business for your trading, because it's up to you. You have to pull the trigger to set up the business if you qualify to be able to deduct all of these ordinary and necessary expenses you'll have as a trader. Now, this doesn't look like a spreadsheet, but it is. And if you'd like this spreadsheet sent to you, it's an Excel spreadsheet. I want you to take down another email address. It's learn, L-E-A-R-N, at tradersaccounting.com. Learn, L-E-A-R-N. And you would just send an email, and you could put expense spreadsheet in the subject matter, and we will send it out to you the first part of the week. But let's go over these expenses. They're pretty neat to understand all of these expenses. Even neater is understanding how you can maximize them and how you can document them to stay out of trouble with the IRS. Organizational expenses. Most people will find that it's in their best interest to trade as either an LLC or a C corporation. When they do, they have some expense in setting that up. Now that's what this is. You can deduct that expense in setting up your corporation or your LLC. The next line down, when you do set up your trading business, you've probably already been trading and you have a computer and a desk and a chair and maybe a file cabinet, maybe 17 screens. Who knows what you have? But why not sell that to your new company? It's going to be an expense that they can write off. You're not going to be able to write it off as an individual. So go ahead and sell it. You're going to have to sell it at fair market value on the day that you do, but that's not hard to figure out. The next one is a big one. These are called investigatory expenses or pre-incorporation expenses. You can go back 6 to 12 months and accumulate all of the business expenses you've had before you set up your business, bring them forward, and on the day that you set up your business, you can write off $5,000 of the expense, and anything over and above that $5,000, you're able to amortize over the next few years, so that in essence you're able to deduct all of it. That's the amortization on the next line. Now, when you start trading as a business, if you decide to, you need to learn a whole new mindset. And that mindset says, hey, I want to be able to capture every nickel that I spend in expenses, because some of the items are not going to be real big. And one of those items is automobile expense mileage. Now, for some traders, it can be bigger, but most traders don't have a whole lot of reason to have an automobile that they use in their trading expense. The significant difference to that is the fact that if you belong to a trading club and you go to meetings during the week or during the month, that's certainly an expense for your automobile. Where it becomes some pretty big money is if you drive to the Traders Expo or to a seminar that your trading guru is giving. Now, it's up above 55 cents a mile. When I wrote this, it was at 55 cents a mile. So let's just look at it. Let's just take the trader that only goes to his trading meeting, and let's make it even once a month. And it's 10 miles away. So he's got a 20-mile round trip times 12. That's 240, I think. Anyway, all of that multiplied by 55 cents a mile is not going to make you rich. But if you're able to deduct $1,000 for automobile expense mileage, and you're in the 25% tax bracket, there's $250 more that you're able to trade with. Now, payroll is the next item we got up here. We don't normally recommend that you pay payroll, because when you pay payroll, you've got payroll taxes, and that's that can eat away any advantage you have in paying payroll. There are two reasons that I can think of that we would encourage you to pay payroll. And one of the things you get when you work with Traders Accounting is a tax accountant or tax attorney to work with to make all of these decisions. But let's say you've still got kids at home and you're paying them an allowance. Have you ever been able to deduct that allowance? I didn't think so. But if they are anyone interested in your trading and you can teach them and you can give them a legitimate job, whether it's researching the market, whether it's cleaning the office, whatever, as long as it's a legitimate job, you can pay them a salary. And up to a certain point, they don't have to pay any income tax on it, nor do they need to pay any payroll tax on it. So utilize that if you've got kids at home. The other reason is that if you are a successful trader and you're making buku bucks, you're looking for secondary tax strategies, aren't you, to cut down the amount of taxes you're going to have to pay? The best one that I know of is to set up a 401k, and this would be a self-directed 401k that you can set up through Traders Accounting, which will allow you to take whatever percentage you want of your winnings at the trading game and invest them in a 401k. This becomes an expense to your business, but it grows, and you can trade in the 401k. You can, if it's self-directed, you can actually buy real estate in the 401k, make other type of investments in the 401k, so that you've got multiple streams of income. Now, there's another reason for a 401k, which I will go through in a little bit of time, but that's the two reasons that I would recommend that you may want to pay payroll. There are others. I had a client not too long ago came to me and says he wants to start paying payroll. And I said, why? And he said, well, my wife is 2 quarters short of being able to maximize her Social Security. So I'd like to put her on the payroll for 2 quarters. Well, I thought that was a pretty legitimate reason to do so. Skipping down to the bottom of the page, a medical reimbursement plan. Now, I don't know about you. I think I'm pretty smart. I think you're pretty smart for being here today. But I'm still confused about the insurance and the Obamacare and everything else that's going on. But here's one thing that I do know. If you have a legitimate business, and if that business is a C corporation and only a C corporation, it has the ability to have a medical reimbursement plan. This medical reimbursement plan can reimburse whoever the corporation wants to reimburse for all of their medical expenses, including doctors, prescriptions, drugstore items, even over-the-counter items that you buy in the drugstore. It is a true reimbursement plan. You cannot pay for these expenses out of the corporation, but at the end of each month you go to Excel and press new once you're into Excel and look for the templates, get an expense report, make an expense report out for yourself and your family for all of the medical expenses you had. Hand it from your left hand, which is you, to the right hand, which is the corporation, and the corporation can then write you a check for all of those expenses. And that becomes an expense to the corporation, which is fully deductible. Ain't life great? Now, the rest of them I know that you're already familiar with because you're already paying for a lot of them. Dues and subscriptions and educational expenses. These are some of the bigger ones we have. And if you are in business, and if you qualify to be in business, these are expenses that can be deducted. Equipment repairs for your computer or anything else you've got in your office. Licenses and permits. There's only two or three towns in America I know that insist that traders get a city license. One's in Ohio, two are in New York City, some of the boroughs of New York City. So normally you don't have any local, but state, if you are a legitimate business, they will ask you for a contribution once a year. Again, if you'd like a copy of all of these expenses that we're showing, you're going to send an email to learn@tradersaccounting.com and request it. Home office deduction. I know there are still accountants out there that say, oh, you never want to mess with the home office deduction. It raises a red flag. Next time you hear that, just tell your accountant that anything you don't know how to do that you do on your tax return is going to raise a red flag. But hey, the IRS even has a booklet on how to legitimately take your home office deduction. And there are 2 or 3 different ways that you can do it. Excuse me just a moment. I'm in Phoenix and it is dry, let me tell you. Whoa. Bank service charges, office supplies. A lot of times, unless we keep track of them, we don't really realize how much money we spend on office supplies, which would include ink for our printers and things like that. Now, you can read a lot of them. Another big one is at the bottom there. If you go to a seminar that's out of town, or if you go to the trade shows, you do have hotel expenses and travel expenses. So those are the expenses that a legitimate trader might take off. So now, we also at Traders Accounting, if you're not familiar with our website, have periodic webinars going over each of the major classification of expenses, what you can claim, how to maximize it, and how to document each of these deductions. That's the most important part of being able to make your trading tax efficient. So you can check out our website for dates and times. I don't really know right now when our next one is. The IRS classifies traders in 2 different ways. First one is an investor. Now, we generally think of traders or investors, excuse me, my phone keeps going off here. We generally think of investors as people who buy stocks, hold them for long-term appreciation, and to receive the dividends. But any trader, no matter how many trades you have, you could have a bazillion trades a year, be trading $5 million in your trading account, but if you have not set up a business to trade in, the IRS is going to consider you as an investor. There are tax court cases where a gentleman in New York not only traded a ton of money, made a ton of trades, he had an office building in downtown New York City, hired people to help him, tried to take some of the expenses, and one was unable to because he was not considered to be a trader by the IRS. Investors are really low on the food chain. They're always going to be subject to the $3,000 capital loss rule. Now, here's another big expense. Let's say we've got John Newbie Trader who starts trading this year. He's still in the learning mode and he loses $13,000 trading. And he's still trading as an investor. You and I both know that he can only deduct $3,000 of that trading loss. However, if he was trading as a business and had set up his business correctly, he could deduct the whole $13,000. So there's $10,000 difference at 25%. Well, you do the math. Again, it's not chump change. You've increased your trading capital by quite a lot. An investor is always going to be subject to wash sales. Any expense that the IRS says he can deduct, are going to be subject to the 2% threshold. But most expenses are not deductible because the IRS considers them to be hobby expenses. As an example, any margin expense is only deductible to the extent that you would make money trading. Let's say you have $2,000 in margin expense, but you don't make any money trading this year. Goodbye margin expense, you can't deduct it. Now, investors, hobby expenses, no business deductions allowed. The business of being a trader in business. Now, you could hold a gun to my head and ask me, what kind of a business should you have? I don't know. I'd have to talk to you and find out a whole lot of information. And this brings up one of my pet peeves. I was even listening to a ball game yesterday on my Sirius radio, and during the commercial break, this ad comes on for a company that'll set up an LLC and for $69 or some damn thing like that. Well, how do you know that the LLC is going to be the best thing for you? Why do people just go out and set up LLCs? Because it's only $69? That's a crock, because by the time you get through, it's probably going to be $469 if you really want the paper that it goes on and yada, yada, yada that you're going to need to really have set up your LLC. But you don't even know that an LLC is the best thing for you. And if you set up the wrong entity to trade in, it could end up costing you more money than if you hadn't done anything at all. So businesses, they're sole proprietors. Then there are formal business entities such as C corporations, LLCs, and limited partnerships. Now, I know I'm going to get the question. If you've already written it down, I'll just skip it. Why would you not want to trade in an S corporation? Well, an S corporation fits down at the bottom there. An S corporation is a flow-through entity, while a C corporation is a separate taxpayer. But with an S corporation, the IRS has always deemed it appropriate that about 50% of any profit in the S corporation has to be paid to the shareholders as payroll. When you pay payroll, what else do you get to pay? Sure, payroll taxes. However, if you're trading underlying trading, if you're trading in an LLC or a limited partnership, there are no payroll taxes. Now, I said underlying trading because if you're painting houses in an LLC, yes, you're going to have to pay payroll taxes. How do you decide which one of these are best for you? Well, there is no cookie cutter approach to this, folks. Honestly, there is not. If you would like, we've got a 9-page tax guide that goes into each one of them and the advantages and the disadvantages of them. You can either go online at tradersaccounting.com or you can email that learn@tradersaccounting.com or call my buddy Raven. Her number is there, and ask her for this. It's a free 9-page guide on tax strategies. And again, it's free. Tax tribulations for traders. That's almost poetic, isn't it? The 5 major mistakes that cause the most IRS audits for traders. Well, we should know this, shouldn't we? When your tax preparer software does not completely understand the ramifications of the following. And believe me, this happens because we have to redo tax returns that were done either by TurboTax or by one of those tax companies that have their offices in little malls next to Safeway. And they will not tell you that they don't know how to do traders taxation. A legitimate CPA firm will tell you if you ask them whether they have the experience to do taxes for inactive traders. But here are the reasons. A lot of preparers don't know what wash sales are, don't know what mark-to-market is, don't know the capital loss rules, how different trades are taxed, and this is a big one here, and the qualifications necessary to be a trader business. So let me start by giving you some knowledge that you can ask the question if your tax preparer says they know all about traders taxation and you are feeling queasy and not real sure. Ask them what wash sales are. Now, the definition of a wash sale is where you own a security, sell it for a loss, and repurchase it within a 30-day period. Now, just to muddy the water a little bit more, you could own Microsoft, sell it, and buy an option on Microsoft, and you would still be subject to the wash sale rule. It does not have to be the same underlying that you buy and sell. Now, the example I have here, and I know that's not Microsoft, I can't remember who it is, but we own it at 25 bucks. On December 1st, we sell it for 22 because our technicals started going down. We've lost $3. We buy it back on 12/28 at $23. We don't have any loss because we have just triggered the wash sale rule. Now, what happens to it? Well, we owned it at 25. We sold it at 22. We had a $3 loss. We buy it back at $23. The loss goes to zero. However, the underlying price for that second purchase on 12/28 now becomes $26. That loss is rolled into the price that we paid the second time. Now, let's say we had 1,000 shares. So we've got a $3,000 loss here. But we're not going to be able to claim it on our tax for this year because you can see the dates. In order to get out of that wash sale, we're going to have to hold that for 30 days before we sell it. And we can't because we bought it on the 28th, 3 days before the end of the year. So while wash sales are important to note throughout the year, they're really important to be on top of in November and December. I know that there are a lot of brokers out there that are attempting to give you wash sale reports. I don't know how accurate they are. We looked at a couple a few years ago, or 2 years ago, not a few years ago, and they were not accurate. So be careful with those. There is software on the market that you can buy to take care of your wash sales if you really have a concern about them. Now, if you're trading as a business and you set up your business in a manner you can get rid of the wash sales, and I'm talking in code there. I know I'll get to it in just a moment for you. Okay, what is a trader in securities? Well, the first thing, it's a sole proprietor. That's all it is a sole proprietor. There's no election necessary. If you qualify at the end of the year, you just file a business tax return, one-page return, and you'll put your revenue and your expenses in there, and the Schedule C will then go with your 1040 tax return, and you're able to deduct all of your trading expenses. Now, is a trader in securities the best way for you to go? Again, I don't know. My concerns are, though, there's nothing in the tax code about this status. It's just something the IRS has come up with for some reason. And everything we know about it is from a tax court case. The other thing that we know is that 1 year's tax court case may be overturned the next tax court year. I'll talk to you about Chen versus the commissioner in just a moment. But in addition to all of that, sole proprietors are audited much more often than individuals or formal entities. Now, IRS Publication 550, which you can download from the IRS website, at the very back has 2 paragraphs concerning trader and securities. The first one is special rules for traders and securities. Now, what I have done is put into red those things that are pretty nebulous to me, and depending on if you were audited and you got someone that thought a little differently than you are, could mean completely something different than you thought it meant. The first one is you must seek to profit from daily market movements in the price of securities, not from dividends, interest, or capital appreciation. Well, they're trying to segregate the investor now away from the active trader. And I believe what that says is you need to be a short-term trader. However, you are now Lucy Bell Kumquat, and you have just joined the IRS, and you are going out on your first office audit. And you've got a trader that is claiming that they are a trader in securities, a sole proprietor, but you note real quickly that they haven't bought and sold the stock every day. They've held some for 2 or 3 days. And so you go to this rule and you say, hey, you don't qualify because you didn't profit from daily market movements. You can't profit till you sell. That's why I say it's nebulous. The second rule, your activity must be substantial. Come on, IRS. Holy crap. Why can't you give us a number instead of something that says substantial that doesn't mean anything to us? Now, we know a trader that had 338 trades and was considered to be a trader by the IRS because he dotted all of his I's, crossed all of his T's for the other rules. But then we've known traders with more than that number of trades that have been denied by the IRS. What I like to do is go on the number of hours you spend trading, because there are a lot of references in the IRS code about 500 hours being what a legitimate business, or the minimum a legitimate business would spend on their business. So 500 hours is about 10 hours a week. You cannot hold yourself out to be an active trader unless you spend more than 10 hours a week. I don't know how you'd get by, because that would include listening to webinars like this. Excuse me again. That would include webinars, that include all of your studying time, all of your time looking at charts, and then the trades. So I like to look at it at 500 hours, but that in $2.50 will get you a cup of coffee at Starbucks, because that's just my opinion. Now, the next one reminds me of something in a blue bottle my mother used to make us take all the time. You must carry on the activity with continuity and regularity. But what they're saying here, and there's been several tax court cases, not only about traders but about other businesses, where the IRS has maintained you can't go into business for a short period of time. If you go into business, you've got to be in business always. Now, what that means is you can't go in business and then shut it off because you want to go away for the summer. If you go away for the summer, you better figure out a way to trade. So continuity and regularity. Now, the next paragraph just says you need to consider these things also. The typical holding periods, the frequency and dollar amount. We have no idea what they mean by dollar amount. I've not seen a tax court case that spells that out. And the amount of time you devote to the activity, and I'm saying I think 500 hours is the minimum that you would want to put in there. Now, several years ago, we had a very, very famous tax court case called the Frank Chin case. Frank Chin was the vice president of a dot-com company in the Silicon Valley. And one year he decided to trade. I think he took, let's say, about $80,000 out of a savings account, put it in a brokerage account, started trading. To my knowledge, he'd never got any education, trading education. And within 3 months, he'd lost all of his money. So he did the smart thing at that point. He quit trading. Now, the end of the year came, and he did the dumb thing. He didn't file a tax return. Well, I can understand. He's saying to himself, hey, I got paid a pretty decent salary from the dot-com company, but they held taxes from me, so I paid all of that. I lost all of that money trading, so I shouldn't owe any taxes, so I just won't file a tax return. You don't want to do that, folks. I belong to a group of CPAs and accountants that do taxes and bookkeeping for clients throughout the United States. I got an email this morning. One of them just had a client come in to see him yesterday that the IRS had finally caught up with. He had not turned in a tax return for 20 years. It's going to cost him a lot of money because the IRS is going to expect returns for all of those years. And if he doesn't come up with them, the IRS will come up with them. So he's having to pay my friend, the accountant, a good penny to resurrect all of this stuff. But Frank decided he wasn't going to do it. So 3 years later, he gets a letter from the IRS and says, hey, we'd like to see you, Frank, and bring your returns because we can't find them. Well, he went in to see him, and they said, you've got to file these things or we're going to file them for you, and you won't like that. So he hired somebody to file them for him. I hope he hired somebody. But they weren't very smart either because they filed him as a trader in securities. And one of the benefits of trading as a business is the fact that you can elect a mark-to-market election. Now, what that mark-to-market election does is allows you to convert all of your capital gain or capital loss to ordinary income or ordinary loss. Why would that be important? Well, certainly, if he was able to do that, he would then be able to take all of his capital loss, convert it to an ordinary loss, and deduct it against his payroll, or his payroll from the company that he worked for. Well, he filed it all this way, and the IRS got it and told him that he was wrong. He couldn't do it. Well, he wasn't satisfied there. I have no idea who was advising him because none of this was new. But he took it all the way to the tax court. And of course, the tax court had no choice either. They said, you don't qualify as a trader in securities. Why? You didn't trade with continuity and regularity. You only traded 3 months out of the year. And therefore, if you were not a trading business, you couldn't make the mark-to-market election. So you owe us all of this money. So that was the Chin case. The judge then came up and said a few other things that has greatly affected the trading community ever since. But that was what the Frank Chin case was all about. Very, very famous case. One of our clients set up an LLC to trade in, forgot to transfer his trading account into the LLC, went all year trading, called me at the end of the year and said, hey, I forgot to put my brokerage account in the LLC. Can I take those expenses? I said, I don't think so. He says, well, I'm going to. And I said, well, then you're going to find somebody else to do your tax. He says, okay, so he did. The IRS caught up with him and indicated that because he had not transferred his majority of his trades into the LLC, he couldn't be a business. Now, there are some accountants out there that take that and say, well, he wasn't trading enough. He'd only traded 500 and some trades. But what they're not realizing is that the 500 and some trades were done in his own name, not in the name of the LLC. So one of the elections you can make if you're in the business of trading is the mark-to-market election, and it is an election. You send a letter to the IRS. But it's not always the best thing to do. It's only available to somebody that's trading as a business, as I stated earlier. It changes capital gain and loss to ordinary income or loss. It does away with the wash sale rules, but there are stringent rules on when and how you elect it. You have to elect it by no later than April 15th of the first year you wish to use it. So if you wanted to use it in 2014, forget it. Forget it, because you didn't do it by April 15th. It's past that. But then, hey, I'm playing with you now. You could still do it if you have been trading as an investor and now you set up a business to trade in. You've got 75 days from the day you set up the business to make the mark-to-market election. But that's only in a new business. Okay, you send a letter to the IRS indicating you wish to make the election, and then when you file your tax return, you include a Form 3115 at the end of the year. Also at the end of the year, any open position that you have for tax purposes is considered to be closed, and you will either have a false loss or a false profit on that, which will be included in that year's taxes. When we talk about the taxation of traders, we generally think capital gain, but that's not always true. But just so you know, capital gain, long-term capital gain is anything you hold over 365 days before you sell it. And the maximum tax right now is 15%. Short-term capital gain is anything that you hold less than 365 days, and it's taxed at whatever your tax rate is. And then we have a hybrid for 1256 contracts, which are futures and broad-based indexes. And no matter how long you hold them, they're taxed at 60% long-term capital gain and 40% short-term capital gain. So futures and broad-based indexes are 1256 contracts, 60% long-term at 15% max, 40% short-term, your tax return. They're filed on an IRS Form 6781 instead of a Schedule D. So now, if you've been trading for a couple of years and you've had somebody do your taxes, or you've done them for yourself on TurboTax, go back and see if you were trading futures or broad-based indexes, if you put them on the right form. If you didn't, you paid too much tax. Open positions on 1231 are just like mark-to-market. They're considered to be closed for tax purposes. You can go backwards 3 years and forward 5 years on any loss that you have. And mark-to-market is generally not elected by these traders. Why? Because if mark-to-market was elected, they'd be taxed at their tax rate instead of the 60% long-term, 40% short-term. Forex, the wild, wild west of trading. Cash Forex is not even capital gain. It's a Section 988 trade. It's ordinary income. Now you can convert these Section 988s to 1256 and take advantage of that 60-40 split. But you need to keep a logbook, and every trade that you make has to be said, I'm converting this to 1256. It's not a universal election. So how do you select a tax preparer? I told you when you started you were going to know more than 90% of the tax preparers in America about traders taxation. And not a lot of them understand the ins and outs, and not a lot of them want to. You know, they're doing taxes and things for other type of businesses. So if you've got a decent preparer, just ask them the question. Do you understand traders taxation? But if you're going to one of those tax companies that has the little guy standing out on the street in a green robe with a little crown on and he's waving a thing, they're going to tell you they understand them whether they do or they don't. So just ask them the 3 questions. You know the answers. What's mark to market? It's an election that you take as an active trader. How do you elect it? By April 15th of each year with a letter to the IRS. What are wash sales? Well, you know that. You own something, you sell it for a loss, buy it back within 30 days, you don't get to take the loss. And how are 1256 contracts taxed? 60% long-term capital gain, 40% short-term capital gain. Years ago when I started Traders Accounting, we were in Seattle. There were 3 of us buddies that were trading together. And it was back in the 90s when you couldn't make a bad trade. I mean, it was impossible to make a bad trade. So I saw an article, or one of us saw an article in Kiplinger's or somewhere that said, hey, day trading is really great. People are making lots of money. But nobody can find anybody that does their taxes. So I took it back to the other guys. One of them was an attorney, a litigator. One of them had just graduated from one of the better schools, Stanford, in the state of California, and myself, who'd been a operations type accountant for many years. And I said, hey, we could set up a little company. We could get ourselves the office we wanted to get out of the house to do our trading. I don't know how many of you trade at home. My wife seems to forget what I'm doing when I trade at home and just starts talking. I love her dearly, but she just starts talking. And it's hard to concentrate that way. I don't know whether anybody else can equate with that. If not, just forget about it. And if you ever see my wife, do not bring up the fact that I told you. But anyway, we said, okay, we can buy us, or we can rent us a little office. Each of us take an office. So we did, and we talked to this friend of ours who just retired from the IRS, and he said, sure, I'd like to come with you, and I'll be your tax manager. Great. So we formed Traders Accounting in the state of Washington. Somehow it got out. One of the magazines said, at last, here's somebody that understands the taxation of traders. Our phone started ringing, and overnight we had 750 tax clients. We had one little guy that had retired from the IRS, going to do the taxes. He didn't want him in. He was ready to run. That was the longest year I ever spent in my life trying to get that. I was trying to hire anybody that had CPA after their name. Really a different year. I'm certainly glad we're out of that. We didn't know a lot, but we've certainly learned a lot since then. So feel free to use Traders Accounting. We have some really good tax preparers. Now, if you want some handouts, the slides and the expense sheets, either email me or learn@tradersaccounting.com. It's going to be better if you do the learn@tradersaccounting.com. I think I told you at the onset that I'm going on vacation tomorrow, so it may be a couple days before I get to my emails. Okay, now, what can I do for you? If you are curious as to what entity or business would be the most tax efficient for you, email Raven. She'll set up a free 30-minute consultation with one of our entity specialists to go over it with you to let you know. And she can pass on a special for $8.95 that includes a free name search in your state, the EIN, all the legal documents you're going to need, 3 months of business coaching with our tax attorney, and 3 months of free bookkeeping. It's quite a price. It's a very good price. So anyway, that would be ravenj@tradersaccounting.com. And now it's time for questions. It takes.
Okay. One question here is one trader says, I can trade in the morning and go to a job in the afternoon. Will the IRS accept me as a trader or because I have a full-time job? Is there any sort of conflict there?
You know, I don't believe there's any kind of a conflict if you can convince the IRS that you've spent at least 500 hours a year on your trading. Now, the one thing that I didn't say is that for goodness sakes, get a good day timer and put it on your desk and keep track of all of the hours you spend on your trading activities. Because if you're ever audited, it's going to be 3 years, and it's up to you to prove to the IRS that you did trade that many hours. So get a good day timer, put it on your desk, and make sure you religiously fill it in when you are working on your trading.
Excellent.
Next.
Okay, next question is talking about where to set up a trading business. The question is, should we set up a trading business in Las Vegas? Maybe they're referring to Nevada. I'll let you expand on that.
If you live in Nevada, yeah, go ahead and set it up there. If you don't, for goodness sakes, don't. The rules are pretty severe. They're called the Nexus rules. And it says that your trading or any business should be set up where you have your major activity. Now, you can get by, and people have for several years of trading in Nevada, but there is no advantage to it. A lot of these trading seminar companies are less than honest when they tell you there are benefits to setting these up in Nevada. The first benefit that they tell you is that they don't have an agreement with the IRS. What difference does that make? Are you trying to hide something? Because they're going to sell your name, your address, and your phone number, the state of Nevada is, to whoever wants to buy it. And Nevada costs more than almost any state with the exception of Illinois to set a business up in. So you're much better under normal circumstances to set it up in the state that you live in. Next.
All right, sir. If I trade in an IRA account, should there be any taxes at all?
That's a bigger question than it sounds right off the top. No,
Right.
You're going to pay taxes in an IRA when you take the money out. But when you trade in an IRA account, you cannot be classified as a business. So you will not be able to deduct any of your expenses. A way around that, if you want a way around, is to set up a self-directed 401k. Move your IRA money into the 401k. You can then borrow up to $50,000 from the 401k to do anything you want to with it. Set up your trading account, qualify as a business, and deduct all of your expenses. The other thing that was announced this last week, I don't know whether you saw it, but the Supreme Court ruled that IRA money, when you die, your heirs are susceptible to having to use that to pay your debts. It is no longer sacred money. A 401k is still sacred. So, next.
All right, Jim. Well, just a couple of more. I think I can help answer some of these. Question is this session being recorded? Yes, it will. It will be available on valuecharts.com in our blog section. So you'll be able to see that. I just ask you to give me about 24 hours to have it actually up on the website, because it does take that long to actually process the video and then get it all uploaded to YouTube. But it will be there for you to review, because I know Jim gave us a lot of good information today. I know some of you are asking a little bit more specific type questions. Now, I'm just going to go ahead and repeat what Jim said. He mentioned that you can contact him. Now, that is his email, but he also referenced the email address learn@tradersaccounting.com. And you try to direct your questions probably to that one, since Jim is going to go on vacation. But do that, and then I'm sure his company will be getting back to you and assisting you. Because I've actually talked to Raven before, Jim, and for my own personal business. So it was very interesting, and they're very helpful there. So please take advantage of that. Okay, but I actually think we're through the questions, Jim. Did you want to finish with anything else, sir?
Just say thank you. Thanks, everybody. I know you had other ways to spend your time today, and I appreciate your being here. Hope to run into you somewhere down the road. Thanks to Value Line.
Thank you very much again, Jim. Again, Jim is out on the West Coast, and we appreciate him taking the time and doing a great presentation. That's one aspect of trading that we lots of times don't talk about, is the business of trading. So it was really good to actually get that from Jim today. Our next speaker is Jeff Gibby.
And I very, very much enjoy it. And I'm in charge of our business development department now. And that means I travel all over the place. Going to Australia here in a couple of weeks. Just kind of showing people how to use the software, setting up distribution in international countries, and that kind of stuff. So it's definitely something I very much enjoy. Today, what I'm going to kind of talk about is one of my favorite systems in Metastock. And the reason I like to show this is there's a lot of stuff we can show in Metastock. And believe me, I've spent 2 weeks training people on how to use the software in different countries and stuff like that. But I want to give you something that you can use right out of the box. It's easy to use. It's really 3 simple rules. So let's go ahead and get started, okay? Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to using and interpreting specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. And Metastock shall have no liability for any investment decisions based on the use of the software, trading strategies, or any information provided in connection with the company. I lost count on how many times I've read that, but I definitely have it memorized by heart. On another note, too, just so that you're aware, I am not here to give you an investment advice at all. And in fact, I'm not licensed to do that. What I really want to do is I want to show you kind of a simple trading strategy. I love to show this because it works on a lot of stocks. Actually, I've got a whole slide on why I love to show this. So I want to get really specific, though. I'm going to kind of show one thing in the software. You know, Metastock's a huge tool. It's probably got one of the most advanced system testing capabilities that are in there. The scanning, you can do full market scannings in the software. There's even a forecaster that allows you to kind of, that is very cool, that's brand new to Metastock. And, you know, we have information about a lot of this stuff on the website, but the only reason I include this as a slide is I want you to understand that we're just talking about a very, very small part of the tool. Not that it's not important, but there's so much more. Our Zenith product, if you're a real-time trader and you're interested in like news and stuff like that, our Zenith product is actually a product that Reuters put together, and they spent like $1 billion on it. And very, very cool. All the time I get people that are canceling much more expensive services to get our news. And very, very, very cool product. So, but I had to kind of get really specific about what I want to cover, just because there's so much we could cover. And certainly we do training all the time. We've got lots of training that's available for free on our website. And so my goal today is kind of give you something you can go home with. I do have, normally I have like a 2-monitor setup, but because of the commotion this morning, I only have a 1-monitor setup. So what I'll do is I'll come in and I'll check on questions every now and again. But you know, I'm just glad I could make it in this morning. So, morning for me, afternoon for probably most of you. So we were started in 1982. It's a company that was started by Steve Kalis. Back in 1995, we were purchased by Reuters, and I started in '97. So they were owned by Reuters for a couple of years. We've released some really cool real-time technology. We're very proud of what we've done. We have users that are in 90 different countries. And there's a couple things that I just want to mention before we get into the presentation. And this year, actually, my slide's out of date. It's official now. We won for the 24th year in a row. Best software in our price category. And we won Pro this year as well, which makes it 10 times. So we're pretty happy about that. The other thing that we're really, really happy about is every year we'll query our customers to see how they're doing. The percentage that say that they're more successful in the markets is like right around 85, 86%. People love it. It works really, really well for people. So let's go ahead and kind of just, we're going to kind of only spend a few minutes in PowerPoint. I want to kind of show you really how the system works, kind of go through the rules, how you would kind of adjust trades and things like that. But I always get the question of who Rahul Mohindar is, so I'm going to tell you who he is. Rahul Mohindar is actually a dealer that we have in India. And he's, over the years, been our most successful dealer in the world. He teaches a lot of people how to trade in India, very, very seasoned. And he does a lot of work with CNBC and CNN in India to talk about kind of his methodologies. What we noticed is what happened, and the reason we kind of started to include this particular model in the MetaStock program is we had him in our office in Salt Lake City, I would say probably maybe 6 years ago, maybe 7. And we asked him what he taught his students how to trade and kind of some of the methodologies that he used and that kind of stuff. And he showed us this particular system. And we liked it. We basically include it with MetaStock for free. And it's actually one of my favorite systems in MetaStock. It's the one I would say I would use most often. So I'm glad we bought it for a number of reasons. I have a lot of customers that have over the years say, I really love this RMO system. It's all I use to trade. And personally, it's one of my favorite systems as well, as you'll see as we kind of get going. It is a trend following system, so I included a definition. I'm not going to read this to you, but you know, the trend is your friend. I'm sure you might have heard that. Maybe like a rising tide lifts all boat, or befriend the trend, and whatever it might be. It's almost a bit of a cliche in the market. Everybody wants to kind of look at kind of what the direction of the trend, buy stocks when they're strong, sell them when they're weak, and kind of trade in the general characteristic of the trend. So this is a trend following system. I'm going to show you, it's very, very specific in terms of being able to kind of say, okay, are we in a bullish trend right now? Or are we in a bearish trend? My goal today is really just to kind of help you understand exactly how to define that, how digital it is, and understand what you're doing in the marketplace. So again, the reasons I like to show this is, again, it's very easy. At no point, if I do my job properly today, you'll fully understand the system, the rules, how to place your stops, how to get in, how to get out. It's totally, there's 3 rules that are involved, and then there's some money management rules that come into play. But it's a very, very simple system, and that's the reason I like to show it, because MetaStock is a fairly complex tool. It's a huge toolbox, and we give it to traders, and we say, okay, this will help you make money, but we want to keep people using it, and I'd like to give this because it gives you something that you can use right out of the box, if you would. Okay. You'll also notice that during this class, at no point I'm going to say, well, I think QE4 is going to do this. Or I think that earnings are going to come out on Apple and it's going to gap up real strong, which just happened. What we're going to notice, and when I teach this class live, is every part of this is not subjective at all. It's 100% rule-based. So we're never trying to make educated guesses about earnings or QE4 or a sudden news announcement or that kind of stuff. What we're doing is we're analyzing the trend. If you use the system properly, you're going to use solid money management. You're going to have a stock in place. You're going to understand what your proper risk is. And it does work on a lot of different instruments. I've shown it everywhere. Uh, from Saudi Arabia on Saudi Arabian stocks to Egyptian stocks to Australian stocks. It doesn't work on all instruments. It's important to kind of find the instruments that it works well with. But it does work on a lot of different instruments on a lot of different time frames. I have a lot of people, I was reading myself, I'm going to kind of focus on daily charts because that's what I use. But I have a lot of people that say, hey, I like to trade this on a 30 or 60-minute chart, and with Metastock Pro, you can do that. And again, it's a 3 easy-step process. So what we're going to do here is the first step, since we want to follow the trend, it makes sense for us to be able to identify what that primary or that prevailing trend is. So if we know that we're bullish, we want to take trades that are long trades. If we know that we're bearish, we want to take trades that are short trades. So it makes sense for us to want to be able to identify that primary or prevailing trend. And that's really what the first and second steps are about is, okay, are we strong or are we weak right now? Or should we be buying or should we be selling? That kind of stuff. So I'm just going to go ahead and switch over into Metastock. I've got it preloaded and ready to go. And I did open up a chart of the Dow Jones Industrial Average. We could probably look at a couple of examples a little bit later, depending on how I go at time. Sometimes I go really long. Once I get talking, I talk and talk and talk. So let's just let me show you how to kind of apply the templates and how to start reading it. And we'll start with step number 1. So if you're someone that doesn't have Metastock, I'm just going to close down this chart real quick and show you how to open it up. It's very, very easy to do. Okay, what I've opened up here, right here, I've clicked on my Power Console, and here I have the different tools that are available to me from within the Power Tool console. We've got charts, Explorer's full market scanning. Here's our system tester, and we have a brand new forecaster, which is very, very cool, cutting edge, patent pending technology. What I'm going to do, what we're going to focus today most on is charts. So I'm going to go ahead and open up the DIA. And maybe Apple, AAPL.O. And I can just put in as many different symbols as I want right here. I just kind of type in the ones, separating them with a space. I can open up as many charts as I want. Go ahead and click on Next here. And what I'm going to do is I'm just going to load in about 2 years, so the default records. With Metastock Pro, I can select either like minute charts or 30-minute charts or hourly. I'm going to focus on the daily charts. And then what I want to do at this point is I want to apply a template. So that'll apply all the rules, the buy and sell signals, and all that stuff that we'll work with. So I'm going to go ahead and click on this down arrow right here. Okay, and what I'm going to find is I'm going to find the RMO trade model right here. Okay, that's all I have to do. Click on Open a Chart, and it'll open up those 2 charts for me. We'll go ahead and grab the data for them, all that kind of good stuff. Okay, so we've got Apple here. Should have opened up diamonds as well, and I'll just kind of push it so that we're looking at both charts. Okay, now. Yeah, let's do Apple. I normally do Dow because that's what I trade. But I'm going to play a little bit today. So let's go ahead and look at the Apple charts. I'm sure you guys have been kind of following Apple a little bit over the last couple of days. They had a little bit of a surprise announcements and all that kind of stuff, and had a pretty good gap up if you weren't paying attention on late this week. So I'll go ahead and open this up. Okay. Now, step 1, we're going to get back to the rules here. Step 1 is I want to be able to identify the primary or the prevailing trend. Okay. And now what I'm going to use to do that is I'm going to use this top indicator here that's called the Rahul Mohindra oscillator. It's the green one at the very top. I'm actually going to take the other two of these indicators off because I don't use them too much. I'm going to show you how I use these. So what I'm going to do is I'm going to go ahead and drop this into full screen so you can see it. Okay, and we're going to I'm just going to show you how to identify whether you're in a bullish trend or a bearish trend from a long-term perspective. Okay, and when I say primary trend, remember step 1 was identify the primary trend. All that means is the long-term trend. What is this thing doing long-term? Okay, so when I say primary, that's basically looking at the most amount of data, determining if a trend exists in the stock, and determining if we're bearish or bullish. Okay. Now what I'm going to do here, we'll go ahead and zoom in a little bit. I can do that in Metastock just by clicking this little plus sign. I'm going to make a couple of very easy observations about this particular indicator, if you would. Number one, it's green, pretty obvious. Number two, it's either going to be above 0 or below 0. And sometimes it's way above 0 and below 0, but that really doesn't matter for the way that we want to interpret it. This is a digital indicator. So the way we read this indicator, it's measuring our long-term trend. And it's very, very simple. Primary trend. I'm going to say if it's bullish, basically it's above 0. So if it's above 0, then we're currently bullish on Apple, okay, long term. So if it's bullish because it's above 0, that means two things. Number one, we're not going to, well, a few things. Number one, we're not going to take a trade just because it's bullish. There's 3 steps that are involved to kind of figuring out where you want to trade on the chart. What we're going to say is, so we're only going to take a long positions here. Okay, so as long as it's bullish, we're only going to take long positions. Okay, and we're not allowed to go short. Have my laptop keyboard, so I'm a little slow at typing on this one. But again, I'm just glad I made it today. If we're down below 0, we're going to say it's bearish, which means we would just reverse those rules. We'd be allowed to go short. We wouldn't take long positions. It's that easy. So right now, for the last 4 or 5 days in Apple, it's been in a bullish zone. We wouldn't be looking to take short positions. We'd be taking long positions. Okay, and Apple's been in a little bit of a sideways pattern lately, but right now we're going to follow the rules. We're bullish at how we had that huge gap up a couple of days ago. We're only going to be looking at taking long positions, and that would have happened on the 22nd. We'd be looking to take long positions. Okay, so that's really rule number 1 in a nutshell. Oh, actually, that's not exactly what I meant to do, but that's okay. I'm dealing with a little bit of a littler keyboard. What I'm going to do here is I'll go back into, well, that's my phone software. Again, you guys, I normally close that down. Let me go ahead and go back into the PowerPoint. Again, we want to identify that primary trend. So if it's in a bullish zone, we're allowed to buy, we're not allowed to short, and it's not a trigger to enter. Okay. So that's step 1 in a nutshell. It's really a pretty easy system to use. What we want to do now is we want to identify what the short-term trend is doing. And because I have only one monitor on my home computer and I can't see the questions, what I'm going to do is I'm going to go ahead and take a short break to see what questions have come in, and then we'll go into step number 2. Step number 1, we definitely want to answer any questions that are there about that particular thing. So let me pull up the webinar console here. I'll just see if there's any questions that have come in. And we'll just take a second to answer a couple questions. I'll do this a couple times. Okay, a couple of questions. RMO means Rahul Mohinder Oscillator. Am I correct? Yes. Does Metastock backtest strategies? Yes, Diane. Diane Simmons asks us Metastock backtest strategies. And I like the Metastock backtester. I will be the first to admit I'm very biased. But it does allow you to backtest as many strategies as you want against as many systems as you want through portfolio backtesting. And I always talk to people that may not be computer programmers that really like our system because it's very, very simple to work with and use. Diane says, I find the market trends less and then it chops. In equity, my gains are lost in chop. How can this cycle be changed? Diane, that's a really good question and probably the subject of a different class, to be honest with you. But with RMO, I just kind of deal with the chop on diamonds. There's been periods of time where I'll take 6 or 7 very minimal losses in a row. And then what you'll do is you'll find that what I found is I still make money. So I'm willing to take those chops because when the trend establishes, particularly on diamonds, it establishes in a very, very strong way. To establish trend, you look at weekly and monthly in Metastock. Not with this system, Mr. Smith. With this one, basically, you're just basically looking at the same interval. This long-term oscillator is actually going to be looking at a long-term system. ISPEL says, or ISPIS says, this is the MACD. What are the differences? I can assure you this isn't MACD. I'm very familiar with the MACD system, which is a great system. I like this one a little bit better. It's a proprietary formula, and it's not based on MACD. Cool. Okay. That's the questions for now. Let's go to step number 2. Let me go ahead and minimize this real quick, or get the questions out of my way. And we can kind of go into what step number 2 is. So just to recap what we were doing, we were looking at the primary trend. We're establishing that right now on Apple we would be bullish. Okay. And the other thing that I want to do before I talk about step number 1 is I want to point out the ribbon here on the bottom of the chart. You'll see right here that it's bearish. Bullish, bearish, bullish, bearish, bullish. So you can identify either by looking at the indicator that's above 0, which is very easy to do, or it's also very easy to actually look at the ribbon that's painted on the bottom of this chart to tell you whether it's in a bullish or bearish zone. Okay? Cool. Awesome. Let's go ahead and go to step number 2 here. I'm going to go ahead and maximize these. Let me just hide my view or my control panel. I'm so used to dealing with more than one computer or more than one monitor, but my control panel's right in the way of the button that I want. Let me move that out of the way. And I'm going to move this to full screen. Now there are 2 indicators right now. I'm going to change the view just a little bit so I can kind of get a little bit more specific about which indicator we're talking about. We'll deal with the pink indicator right now. And I'm not sure exactly what the technical color for this is, but I call it pink. And you'll notice that it's a lot more reactive, I'll say it's probably the right word to use, to market conditions. So, and as a result, we're looking at a shorter term time frame. But we read it in the exact same way. The only difference is this is measuring a shorter distance or a shorter time frame. So this is your swing trade number 2 indicator. And we're going to use that to identify what this is doing from a short-term perspective. And we read it the same way. If it's above 0, it's bullish. If it's below 0, it's bearish. So very easily, I can kind of look and say for the last 4 days on Apple, this has been in a bullish zone. Okay, so if it's in a bullish and my long term is bullish, so it has to match the long term. But if they're both bullish, I'm still allowed to buy. Okay, it's that simple. So both of them have to match up. If they're both bullish and we have a long bias and we're only taking long positions, if they're both bearish, then you're basically looking at short positions only. And that's how you would actually read it. As long as they match, you're allowed to buy. Now, if they don't match, and a lot of times they won't, in this particular case, because we've had a very good strong, they both match. But if they don't match up, then you're allowed to wait. Okay? And I think that's very important. We want to kind of move in the direction of the general trend, short term and long term. And what that does, in my opinion, is it helps you keep the odds in your favor when you're trading. So right here we've got a good solid trend we're allowed to buy, and that's simply step number 2. Okay. The other thing that I'll point out with this particular set of indicators right here is you'll notice that when this goes down below 0, because I'm going to point it out to you, that the bars actually begin to color red. When it goes up above 0 for that short-term indicator, we start to color the bars blue for you. Okay? Does that make sense? Hope so, because I can't see if you're asking questions right now. In this particular case, we'd be up above, we'd be looking at bullish and bullish. So we can't trade Apple 2 days ago or 3 days ago before this gap, but we'd be looking to take a long opportunity in it at this point if we just started looking at Apple today. Hope that's clear for everybody. Let's go back to the PowerPoint and I'll just revisit the rules. I think I try and kind of repeat the rules a few times just so that they make sense. So your primary trend, if they're both bullish, you're allowed to buy. You're still not allowed to short, and it's not a trigger. Okay, so in other words, we're just kind of doing our homework right now. We're not buying or selling anything until we get step number 3 in place. And that's where we start to talk about how to manage your money, how to manage your assets, and how to kind of look at that. Okay. If they don't match, you do have a couple opportunities. You can wait, or if you really want to start to take a trade, the meta-stock scanning actually will allow you to find any opportunity that's currently matching for that long-term and short-term trend. So you can use the scanner. And if we have time, I'll show you how to do that. It's very, very easy to use. Okay? Now what we want to do is we kind of want to get in and we want to identify the trigger points. So, and for this particular one, we've identified that Apple is bullish long-term and bullish short-term. What we want to do is now we want to kind of do our trigger. And this will include a lot of important things. So I'd ask you to pay a little bit of attention here, because what we're going to be talking about is how to move your stops and how to kind of trade in conjunction with the trend, and when you get confirming signals to kind of move along with those. So let's go ahead and go back to my Apple chart here. Okay, and we'll just pretend that it's 2 days before this major kind of gap up. So I'm going to pretend that it's 422. Okay, and this isn't going to work out as good as you think it's going to, and I'll show you why in just a second as we get into the rules. We actually probably wouldn't have taken that position just yet. We would have done it at the open, but I'm kind of skipping ahead of myself. Let me jump to the other two indicators right here. And I'm going to change this right here to another line. So we're going to have 2 lines here, okay? And the reason I want to change that to a line is I want to talk about what we're looking for in a buy signal. So right now in Apple, we know that we're bullish long-term. We know that we're bullish short-term. What we're looking for is a change of momentum or a change of force to get us into a particular trade. So in this particular case, the pink line, again, like I said a little bit earlier, is the short-term trend. The green line is your long-term trend. And this blue line, you've probably guessed already, is your medium-term trend. And this is where it gets a little bit different, because I don't care if that's above 0 or below 0. What I'm looking for is I'm looking at the relationship of price and momentum in the market. If I was to kind of study this particular area right here and look at it with the price movement of the chart, what we're going to see is we're going to see a shift of momentum. In other words, this line, both of these lines are starting to head up because the momentum is starting to shift and people are starting to accumulate Apple. And so what we call this when it crosses right here, I'm just going to move it back 1 day here, move this vertical line back 1 day. When this cross happens, what we call that is, Rahul calls it a change of momentum and a change of direction or a change of force. And that when that happens, that's actually our signal to go ahead and get into the market. And in that way, to kind of address one of the questions from earlier, it is similar to like a moving average crossover system. What you're looking at is a very specific way to look at the momentum for the stock. Okay, so the cross that happened between the 21st and the 22nd happened right there. Okay, so if we were looking at this on the 22nd, what we would be saying here is, okay, here we've got a signal to go long. Okay, we went from bearish to bullish yesterday, and we went for long term, and we went from bearish to bullish short term yesterday. That is what we would call a typical trade setup or a trade pattern. Okay, so now what I'd like to do is show you how you would take advantage of that. And with this particular example, you're going to miss the gap. That's just going to be the way that it's going to go. This was a very surprising gap. But you're going to miss it because of the way the rules come into play. I'm just going to show you the way they work. I'm not going to kind of cherry pick things here. What I'm going to do is, when we get this buy signal and everything's confirmed, we're going to look at the recent price activity. Okay, I'm going to look at the high here for this bar and the high for the previous bar. I'm going to say just by a little bit that this particular bar is a little bit higher. So the way we trade this is we take a look at the highs and we put an entry spot right above the highs. What we want to do is we want to be able to confirm that we want an additional confirmation. Let me change the way I'm saying this. We want an additional confirmation that this is going to start to trade in the direction of the trend for us. So what I'm going to say is, if it goes above the highs and we start to get higher highs, if it crosses above this high, it's a confirmed. We're going to go ahead and enter it. And what we're going to do is we're going to enter as close to $533.60 as we can. Okay, 533.60. Okay, that's kind of until the price goes up above that, we're not going to buy. Okay. Now, what we also want to be able to look at is we want to be able to look at kind of where we want to kind of measure our risk and put our risk. And I talk to traders all the time that are like, I put my stops here because this is how much I can afford to lose, which is not a very good way to trade because I don't think it matters how much you can afford to lose. But I do think risk is important. And there's two different ways that Rahul teaches to manage a stop or to manage an initial stop when you're entering a trade. What I'm going to do, before we looked at the highs, now I'm going to look at the lows. The low here is 526, and the low here is right about 531. So this one's lower. Is that right? It doesn't look lower, but again, I'm working on a smaller screen than normal. That's lower. So then I'm actually going to put my exit or my stop loss right below those lows. That's the first way that Rahul teaches. I like this method. The other way, and I'd recommend that you find one that you like, is you play with them and see which one works better for you. The other way Rahul teaches to look at the stops, as you say, is look at a low support area and put in a stop loss right at that area. So if I was using that particular methodology, what I'd probably do is put a stop right here at about 509. Either way, I'm either going to have a stop loss here at 522, or I'm going to have a stop loss here at 509. Okay, so now I've got a good, and I always ask this when I'm doing a class, what do I know here? Okay, well, I know that unless there's a huge gap up in price, which actually just happened in this instance, so the market is never too predictable, right? But unless there's a huge gap up in price like there was, I'm going to get in pretty close to 533. Okay, and unless Apple gaps huge down in price, which again we might have a huge gap down, if I get in at that level, I'm either going to get out at 522 or at 509, depending on which method you like to use, the first one, the one I prefer, or the second one. So what we've got, since I can ask the questions to you and see the responses easily, what we've got here is very important. We've got a measurement of what in normal circumstances is going to be our risk for the market. Okay. Now in this particular case, I know in most cases what I'd know is I'm going to get in at about 533 and I'm going to get out at 522. And for 500 to risk 11 points isn't really that much, but I'm basing that on kind of what the price is doing. Or I'm going to get in at 533 if you like the other stop loss method, and I recommend you play with both of them because I'm just showing you what I like. And I get out at 509, I'm risking about 30 points, which isn't that much on a $500 stock. What is that? 30 points divided by 5. I think that's about a 6% loss. So I know I'm risking either 11 points, which is very little on this particular switch, or 6% on the other stock method. Okay. Now in this particular case, we did have a huge gap up, and to be frank, this is where you would have bought Apple. You'd have bought it at the open here of 568. And you could have made another assessment. Wow, that's a 30-point gap up. Does my risk reward look good? Should I still buy this? But you still know what your risk is, and you can make that decision on the open of the bar. Okay. Now, is Apple going to continue to go up? I guess we'll find out. If you're following the rules very specifically, you would have gotten in on the open of this day. Okay, and I would say that's a pretty strong gap up. Everything looks bullish. I wouldn't necessarily recommend that you buy or sell Apple because I can't. I'm not even going to say what I would probably do because I don't want to get into the whole business of recommending. It's just not my job role, and I certainly, Okay, so let's go back a little bit as well, because I like to show Apple for a very specific reason. I've done this demo for years now, years and years and years, and a lot of people, as they were kind of talking and we'd kind of go into demos, I'd say, hey, what stocks do you guys want to look at today? And they'd be like, Apple. Apple would come up almost every time. And I kind of go through and start to show how the rules work, and you guys remember Apple, how it was behaving before this year. I'm going to kind of scroll back out here and look at a macro view of this. And we kind of start to go in and look at the signals. I say, okay, you buy here, and you put your stop here, and you move your stop, and you move your stop, and you move your stop. And what people would always say is like, well, I could buy Apple, and I could hold on to it forever. But obviously that isn't always the case. Being able to identify the trend with these very, very huge stocks that go up forever and trade in direction of the trend is very, very beneficial. It says I might be experiencing network connection difficulties. I don't have any internet stuff running, so hopefully everything's coming through pretty good and that there's not a problem. It just popped open to tell me I might be having some network difficulties. What I want to, so I would argue that though, if you notice on this big, huge uptrend, I'm going to go ahead and get this GoToMeeting out of my way for a minute, we were bullish for most of that time. And I would say, and then for the big downtrend that we had after kind of the collapse, I'm just going to kind of go out a little bit more. This big collapse we had, we were bearish for that whole run. And remember, this is up to where it collapsed. You know, it would not, it is a trend following system. I want to give you really realistic expectations of what to happen. Apple topped out at about 699. Okay, we didn't get short on Apple because of how strong the trend was until 639. Okay, but we would have gotten out. I'm going to show you how you would have exited a specific trade. We'd have gotten out probably right about here based on that, and we wouldn't have been long. We would have taken a short position right probably about right here in this area somewhere. And I'd argue that being bearish during this whole run down and only taking short positions is going to be beneficial for you. Okay. Also, saying it the other way, being bearish, if we just use the bullish bearish indicators here to kind of trade in conjunction with what the trend's doing, being bullish during this huge run up and this huge run up and only taking long positions, well, that's what we talk about when we start to talk about putting the odds in your favor. This isn't a sexy system. It's a really good system, but it uses a lot of common sense. So let's go ahead and just kind of, I want to play through one of these kind of scenarios with you so that you understand how to move your stops, how to get out of the stock when the trend comes out, and how to kind of match in those profits and stuff like that. So I'm going to start right about just here at the beginning of this big uptrend. And we'll kind of use our way back machine. And that's always, I will agree, I'm sure somebody that's a little in the audience is going to say it's always easier to trade on this side of the chart than it is to trade on this side of the chart. 100% agree with you. But since I don't have data that's in the future, I had to show you examples that are in history. So I'm going to show you a historical example. We'll use that as a way to kind of teach you how you would actually kind of go through a trade. And then what I'm going to do at the end is show you how you can try this for yourself without on a very, very nice 3-month trial. And if you like it, you can trade it. There's 35 systems in MetaStock that you can use as well. So let's just kind of look at, and I'm going to get even a bit closer here. I just want to be able to kind of just narrow this in. Let's look at kind of right here. Let's say we started looking at Apple at about 2011. So this is way back. Here we would have gotten a buy signal or a signal to get into the market, but again, we can't trade because we're bearish both long-term and we're bearish short-term. So if anything, we'd be looking to go short. We're certainly not going to take this signal that's in the direction that's opposite of the trend, so to speak. The next day, what happens is we get a blue bar, and what that means is we just barely went above zero with our short-term trend, but we're still in a bearish zone. We're still not allowed to buy. It's not until a couple of days later that everything kind of looks good. The traffic lights have kind of lined up for us. And what we want to do now is we want to start to structure in a long position. And the way we would do that is exactly kind of like what we were talking about before. Look at the high. Look at the high on the bar before. And I'm just going to kind of identify that's my high point, right? I'm going to say, okay, if it goes above this point, that's my confirmation. This thing's going to rocket up to $700. I didn't know, you wouldn't know that at the time, but this is my confirmation that when it goes above this level, that we're breaking new highs, and that the trend is confirmed. We're going to go ahead and buy as soon as it goes. And we do the same thing with our stops. Okay, if we're wrong, the low here is 396, and the low here is 392. So I'm going to put it right below 392. Right above that thing. Or if you use Rahul's other technique, you put it right here. So again, I know at this point, I'm going to get in at about $399. If it goes against me, I'm risking $7 a share. I'm going to get out just below 392. In this case, 391. So $8 per share. My mistake. Okay. So the very next day, it opens right below that line. We get in just as close, but as it starts to go up for the day, we would go ahead and buy on this day. Okay. And that's how we would do it. That's how we would structure that trade. Okay. We would buy on this day. I just go ahead and put that signal on the chart, so you'd kind of know exactly what they were talking about. We put on our stop. Again, the stops, if there's anything I've learned, stops shouldn't be negotiable after they're placed. In other words, if this comes down to 392, you get out. You can decide on what strategy you want to use for stops, but not in the heat of battle, so to speak. You want to be definitely, the nice thing about trading this way and with technical analysis is you're not making decisions on the fly. You're deciding what you want to do well in advance. You've got your game plan, and you're going to stick to your game plan. Okay. When you're not trading, well, I bought this, and it's coming against me, but I think I'm going to stop out, and it's going to go back up. Those are not the decisions to be making. The market and this system will give you more opportunities to buy if you're wrong, but generally you want to get out, and you want to preserve that capital, and you don't want to be making decisions while you've got real money. I mean, that's the advantage is, and you hear it all the time, the emotions, you should be buying when people are selling and selling when people are buying. Emotions are not your friend when you're trading. I'm sure most of you know that. And so you want to make the decisions on where your stop loss is before heat of battle. And when you're in the middle of a trade, you're not negotiating these. Okay? So here we get in, boom. Okay, and as long as we're in, we get a nice, well, we kind of get a bit of sideways action. Just going to start to zoom out a little bit. Okay, and we get a nice big uptrend. And as long as nothing really changes on the chart, we're just going to kind of go ahead and let it fish. We're not going to move our stop yet. We're not going to we're not going to get out. We're not going to kind of take a decision just because this is a good trade and we've already made enough money. We're going to stay in there until we kind of get a signal that things might be changing. In this particular case, this was a huge run up. I mean, we've already gone up quite a bit. What happens is, as all markets do, kind of get a little bit of a topping formation. Your signal starts to cross down, and you get a sell signal on the chart. Okay, so we're in a long position. We get a sell signal. I want to be really, really specific about what you want to do here, because this is kind of an important part of the rule set. When you get a sell signal, you're going to take a look at your trend, and as long as you stay bullish short term and long term, you're going to stay in the trade. Okay, this might start to pull back. If everything starts to go negative and then the trend's changed, then we would reverse our trade. But as long as we kind of have a minor bit of a pullback, what we're going to do is we're going to stay in this, because what's usually going to happen in a really strong trend is you're going to establish a new support area, and what's going to happen is it's going to start going up again. So here we've established this support area. The stock stays there, and then it starts to move up again. And that's just normal market behavior. Okay, so we don't necessarily want to pull the plug as soon as it goes against us a little bit. What we want to do is we want to analyze that. So in this particular case, everything stayed bullish, everything was good. What we want to do now is we have that cross that happens. And generally the way I read that is you've established a new support area. You anticipate that the market's going to continue to rise in the direction. You're getting another signal that that's the case on the chart. And what you want to do here is very, very specific. And when I'm doing this class live, I say, what do you think we want to do here? And people say normally buy more shares, which isn't what Rockwell teaches. He's very specific. He wants you to buy as many shares as you're going to do at the start of the trade. But the thing that you definitely want to do is, since you anticipate we've got a new support zone in here, we've made some money, we want to move our stop loss to accommodate that. So what I'm going to do is I'm going to look at the lows here, and I'm going to say, okay, now if it goes down to right here, in this case 541, I'm going to get out. That's my new stop area. Okay, so now instead of protecting my my capital, I'm protecting my profits. Okay, and it works very, very well. So here we go. We go ahead and put this in as a new stop loss or a new stop area. Okay, and it continues to go up, so we kind of just let it fish here. what we're starting to get is we're starting to get a little bit top heavy because it establishes a new high. And again, this is very typical market behavior. We get a signal that that might be changing, and then we get a new thing. And when this market starts to tighten a little bit, our stops start to get a little bit tighter as well. And that's just because the market is it's heavy, it's top heavy at this point. It's likely to change direction. And the RMO allows us to kind of take advantage of that by kind of moving our stops as kind of the trend accelerates. So now we're saying, okay, if it goes below 593, we're going to go ahead and get out. Okay. It doesn't. We basically, it pulls back a little bit here. And then we kind of, here we set up a new stop. At this point, we're just kind of watching the market behavior. We're not stressed out. We kind of know exactly what our profits and losses look like. And here we stop out of that particular trade at 616. Okay, so we got in. It's a great trade. We got in here. We took advantage of most of this big trend up. It went up quite a bit more after this. We would have had more opportunities to buy back in here when it continues to go up. But what we've got is a very good mechanism for kind of taking advantage of these big trend movements. Okay, and I remember actually talking to people all the way through this time of year saying, hey, well, it doesn't matter. Apple's always going to go up. It's going to continue to go straight up. You don't need to necessarily worry about having a trading strategy for this. The trend is too good. But we all know that that's not true. And certainly hindsight has proved that that's not true. It's always better, I think, to have a strategy in place. Okay, and this is a very good one to have. I'm going to show you a couple examples from diamonds. We've had a hugely volatile market the last couple of years. How am I doing on time? Not great. Okay. Let's go and do a little bit of QA, and then I'll kind of just show you a couple of examples, and we'll let you get on with your Saturday. Okay, questions. Let me pop this out. Again, normally I try and answer questions as they come in, but normally I have a really nice office environment with 2 monitors, and I'm not crashed in my basement trying to not disturb the kids too much. So, John asked a question that I think is important. Why do your indicators say sell when price was going up? I didn't see that as an example. I actually read that, when I read that out loud, I totally read it differently when I read it in my head. I thought you were saying, why do the indicators say the price is going up, which it's definitely not. And it's definitely not right. Like I said, I've taken probably the most I've taken in that are kind of choppy trades where you just stopped out, 7 or 8 in a row. CK asked a question, does it work for a shorter time frame, like a 5-minute chart? You know what? I have talked to a lot of people that trade on like a 30 and a 60-minute chart, and they tell me it works really, really well on that. What I would say to you is try it out. There might be better systems that you can use that work on the shorter time frame charts. I don't have a lot of experience with playing with 5-minute charts. Certainly have access to all of the data and all of the charts, but a lot of people ask me, why do you like to trade these systems that are so long term? I mean, you can stay in a trade for 6 months, 9 months, as long as the trend's in your favor. And I always tell them, you know, I work probably like 50, 60 hours every week. I've got 3 kids upstairs, and for me, a system where I'm just kind of trading in the direction of the trend and not stressed out about it all the time works really, really well for me. So the nice thing about being able to do like the extended trial that I'm going to tell you about is the fact that you can actually play with this. See if you like it. There might be something else that you like in Metastock. Remember, it's a very small part of Metastock. Edgar says, can you tell me if this webinar is being recorded? I can absolutely assure you it's being recorded. If you gap down, this is a great question, Diane. What happens if it gap down? So we had that huge gap up. And at that point, we can make a decision if we want to still buy because we know what our risk-reward ratio is going to look like at the very end of the chart, right? If it gaps down, do you honor your stop, is what Diane said. Absolutely. I haven't come into a situation, again, no, that I trade the DIAs, but your stops are not negotiable. So if it gaps down really hard against you, you might be looking at kind of a different market scenario, and absolutely, as soon as it goes below that level, your stop is not negotiable, in my opinion. Okay, let me show you a couple of examples of diamonds. I mean, I think as traders, if you have something that works well right now, in my lifetime, I've never seen such a volatile marketplace as we've had in the last several years. It seems like things are starting to calm down a little bit, but certainly, like if you remember kind of the housing crisis or the big bull market that we had after that, or those kind of things, it's been a great time to follow the markets, and a great few years to trade. I don't necessarily see volatility or trends going away from our marketplace, but I just want to show you a few things, and we're kind of running low on time, so I'm going to switch back over to this diamond chart here and just kind of show you how it works on a major ETF. Okay, now we're not going to kind of get into the nitty gritty of it, but let me just point out we've had a pretty good bull run so far this year. And again, we're bullish this year. Okay, I'm just going to load in a ton of data so I can show you kind of the things that I think are kind of pretty cool here. 2000. Oh, go ahead and changing the wrong date. Let's go ahead and just click on load next one data. 2014. Okay. And what I'm going to do here is I'm going to go back to, with a lot of the instruments, you can go back into the 80s with Reuters data. We're lucky to have so much data, 182 exchanges with Reuters and that kind of, just very good data. So bullish all year this year, with the exception of just a few kind of blips on the screen. I wonder if a lot of you guys, I'm sure you guys have been trading for a while. I wonder if you guys remember that big housing crisis and the big market that we had back then. Where am I at on the chart? 2005. Okay. And again, these huge bull runs are where you're going to make money in the market. Bulls make money, bears make money, pigs get slaughtered is one of my favorite sayings that Robert Dill used to kind of talk about all the time. What I'm going to is kind of the collapse of the market, which happened I think it was right here. This is that big, huge collapse that we had. And I just want to show you, it took a lot of people by surprise, but, the markets weren't just weak at that particular time. They were terribly weak. For 2 years, we had kind of in a downtrend. It would have been bearish since June of the year before that really big surprise with the housing crisis. And so if you were not taking long positions, if you're kind of all in cash, like I was, or short, which I should have been, you would have been able to kind of take advantage of kind of that downward movement. Okay, and I don't know, I mean, I think we kind of forget pain, but you remember how like the whole economy was about to collapse and things were going terribly and there's never going to be a market recovery and all of that kind of stuff. I mean, there was a lot of panic and fear. But eventually what happens is in March, we established a really good deep support level. Okay, and look, we didn't start to go long in March. It wasn't until April that we actually started to go long because the trend was so severe. But I remember being at the money show and we were pulling stock after stock after stock after stock, and it was probably around August or September of that year. And he's like, well, every stock you've showed me told me to buy back in April. And I just laughed at him. I'm like, well, you could have probably just bought about anything back in April. But nobody knew back in April that was going to be kind of that we'd set a new low. It was probably one of the biggest bull corrections I've seen ever. But I've only been following it for 20 or 30 years. There's a lot of you that have been doing it for a lot longer. But for the most part, this is helping you stay in the direction of those overall trends. And this huge bull market that we had, it was bullish the whole time. The correction that we had after that, it was bearish. I have actually a slideshow that shows every single example, but I think you get the point. Trading in the direction of the trend is a very, very valid way to trade. The reason I like it is it's also a good way for you to kind of minimize those losses. And I believe you. I believe some people can actually kind of look at systems, and there are certainly ones that are counter trend. I believe trading in the direction of the trend is, in my opinion, and I say that very specifically, my opinion, very easy way to make money. Probably the easiest way to make money in the market. Let's do a little bit of questions here. Let me pop this out. I wonder if you guys can see the questions. There's only one more. Does the RMO price bars change colors when the swing tree crosses. No, when it changes from blue to red, if you're short-term positive or short-term negative. So it's looking at the short-term trend. That's when it's changing colors. The arrows are indicated when you go from bullish to bearish. Okay, Diane says you can't see. Trend following, I think, is the best way to trade the market. Now, that's just my opinion. And opinions are like armpits. I'm sure you heard that saying before. Some of them are good, some of them are bad. Diana asked, what's the price of Metastock? Well, that's a perfect segue to what we're going to be talking about. Now, there are, because of the thing, I'm not sure I had a chance to kind of get rid of all of the examples that I used during the chart. I did. Luckily enough, I had this all ready to go. Otherwise, we would have been in serious trouble. But so there again, the reason I like this is it's easy. Again, we're not making assumptions based on what housing is doing, or QE2 or QE3. We're looking at the trend. It's 100% objective. We're not making any guesses. We're not always right, and you're never always going to be right, but you're making good judgment calls based on what the stock's actually doing and what investors are doing with the stock. I think that's important. If you follow the rules, you're going to have your stops. You're going to have solid money management. Works on all time frames in Metastock and many different instruments. Notice I say many different, not all. Play with it. I'm going to give you 3 months to evaluate Metastock for a very low cost. And if you like it, you'll probably trade it as much as I do. I mean, I talk to people all the time that love RMO and Metastock and that kind of stuff. Again, we're pretty proud of ourselves, but I think we should be. 24 years in a row. I need to update this slide. Phenomenal. But I'm more proud of the fact that most of our customers actually make money in the market. I was in Vegas for the user conference right around Thanksgiving. It was like a couple of weeks before Thanksgiving, like it always is. And I talked one of our customers into trying Metastock on the same offer I'm going to give you today. And he bought it back in, it would have been November. I met him again on one of our road shows. I do a lot of traveling, as you might imagine. And he basically, he said, okay, I'll do the 3-for-1 trial. If this software pays for itself, I'm going to buy a one-time license and I'll just own it forever. And he was looking at Pro. And I saw him a few weeks later, and he's like, I saw him a few months later, so he had a chance to kind of play with everything, get everything kind of situated and running. And he said to me, in Southern California, I'm trying to remember what city I was in, but I can't remember. You know, you travel too much when you don't remember what city you actually were in. But it was Southern California, and he said, I met him February, and he said, you know what, I've made enough money from Metastock to pay for the real-time version and the data 5 times already. And that was within about, I'd say, 3 or 4 months. Over the holidays and stuff like that. So I really think Metastock is something that's very, very valuable for you. The Metastock, this offer I'm going to give you today, we have an end-of-day version. And I call it end-of-day, but with the latest version, it actually gives you hourly update bars. So you actually can see what's going on in the day, which is something that we just added in October. But it's only $59 a month. And that includes the data for either all of North and South America, which is what most of you, I think, will get. Or you can get Europe, Middle East, and Africa. Or you can get Asia Pacific. So it's $59 a month. And that includes everything you need. You just download the software. It's all ready to go for you. If you buy one, what I'm going to do is I'm going to give you 3. Metastock's a huge tool. I want you to have plenty of time to use it. So basically, March, April, we're in April now, May, June, July. You'd be running until kind of the end of July if you set up today, and you pay $20 a month for that. And that'll give you more than enough to be able to kind of play with all of the tools, the new forecasting, the system testing, the scanning, whatever it is that you want. And what you're going to find is that you're making money and you keep the subscription. Or if you don't like it and you don't agree that it's going to help you make money, you can always cancel it. We don't have anything that's like any contracts that you have to sign up for. This is our offer to let you try it and see that it's going to work for you. Our Metastock Pro program includes the Zenith data, and it's a product of Thomson Reuters. It includes like their real-time flagship product that's called Metastock, or it's called Icon, and we actually call it Zenith. We charge a lot less for it, but you pay about $250 for that. Now, there are cheaper options. You can buy them as a one-time cost, which brings that cost down to $100 or $150 a month. I just encourage you to try it. Give it a shot. If it helps you make money, like anything else, it's more than worth the cost. And with trading software, if it doesn't help you make money, it's not worth even paying for. So give it a shot. This is kind of a low-risk offer. Get you into the software, allow you to go through all the training that we offer and all that kind of good stuff that we've put together to make sure you're successful and that you keep the program. And go ahead and get that signed up, and we can kind of get you rolling with it. Okay. In addition, we include like this Unleash the Power of Metastock that kind of talks about RMO, talks about a whole lot of other things, and even a free month of online training. It's about 60 hours of classroom training, or I'm sorry, the class. It's an hour a week, Tuesday, Wednesday, Thursday. So it's actually 12 hours, but there's more than 60 hours of recorded training that you can go through at your leisure as well. That's done by a company called LearnMetastock.com. So what, in my opinion, Metastock's a program that's going to help you make money. I'm going to give you a very low-risk offer to help you kind of get started and kind of learn what you're doing and totally give the program a test drive. All I ask is that you try it for 3 months. If you like it, keep it. If it helps you make money, that's exactly what you want to do. So to take advantage of that, you can call our sales guys. They're not in today, but you can also go to Value Charts 3-for-1, metastock.com/Value Charts 3-for-1. If you call and mention Value Charts for the extended trial, and here's my email if you want to email me. You're definitely get an answer. I promise. Jeffrey.gibby@metastock.com. Couple questions that came in. Ed says, do you agree that trend trading needs to be done on a daily, weekly, or higher time frame? Not necessarily. I only do dailies. I have customers that do hourlies in 30 minutes. I personally, there was a question earlier of, does this work on a 5-minute chart? I think you get a lot more noise at 5 minutes, so that's why I'd encourage you to try it. But for me, I've done trend trading on a daily chart for years. I don't think you need to go any higher than that. I have customers that have told me that they're successful trading them on the hourly chart. It's just, you know, if I stopped working and start trading, they probably wouldn't, my performance at work would suffer, I'm sure. We do have videos, Diane, on how to do all the scanning, the back testing, how to use the forecaster, how to use all of the tools. I mean, we want to make sure you're using it, and those are all available for free, and they're up on our website. Diane says, do we pay for strategies as well? There's about 40 or so systems that are built into the system that you can test and you can look with and you can play with. And I'm sure you'll be able to find something that works well. ETF, Diane, is, wow, that's a good question. I said wow because I hope I can give you a good answer. An ETF is like buying a stock in some ways because you can buy it like a stock. You buy shares of like DIA. Is like buying a stock. You can buy them as you would a stock. But really what you're doing when you buy an ETF is you're usually buying, in the case of diamonds, you're actually buying the Dow Jones Industrial Average, sort of. I mean, it's basically a mutual fund where they keep their, they keep it so that as the Dow Industrial goes up, the diamond will go up, the DIA will go up. So it's a way for you to kind of make a broad-based assessment of the market. The reason I like to do that is because I think it's a little bit less risky. It's not like you're going to get a huge gap up on the dies or a huge gap down. It just doesn't happen very often. It does gap up and it does gap down, but it's not like what happened in Apple a couple of days. So it's kind of a little bit safer. It's also a good way to kind of be able to trade a broad-based index. Edgar asked, does it work on futures? You can, yeah, absolutely. We have 182 exchanges that we cover with our Reuters data. So that's stocks and futures and that kind of stuff. Now, does this system specifically work on cattle? I'm not going to answer that. What I would encourage you to do is actually play with it. That's the nice thing about it is you can. It's one of the things about trading is that you should treat it like a business. And you can totally go in and see what your drawdowns and your things are going to look like before you start trading. That doesn't mean it always is going to stay the same, but it does give you a good idea of what to expect, which I would say is a very good advantage. Jamie says, does it work with options? We do have options data in there. Most people are going to use option data as kind of, let's say that we got a long signal of some sort. They're going to basically be looking for a directional approach to choosing the meta stock, and then saying, okay, well, I think it's going to go up, so I'm going to buy this particular option, matching that strategy. That's the most effective way to use it, because you can pull an option chart into MetaStock and you can do analysis on it, but they just don't trade with kind of the same veracity as the underlying instrument. So usually the option traders that we have, and it's a huge percentage of our database. I mean, we, as part of that survey I mentioned, you say, okay, 60% are futures, 40% are options, or 60% are stocks, 40% are option traders. But that's a little misleading because that's 100%, but they can choose multiple instruments. Like the total is like 250, but a huge percentage of our database is trading stocks and options. All right, that's the end of the questions as I see them. I want to make sure that I say thanks for coming in today. I appreciate your time. I hope that's valuable for you. I hope, if anything, my big goal was to get you to try the program for 3 months. If you do that, you're going to like it. Most of the time, people keep it. Try it out. Give it a shot. If you like it, you're going to love it.